Good morning, everyone, and welcome. It's nice to see so many familiar faces. This is the Leases Post-Implementation Roundtable on September 13th. My name is Alicia Manders. I'm one of the assistant directors at the FASB staff and a member of our post-implementation staff team. We have both participants around the table, and then we also have some people joining us via Zoom. So to start out the meeting, before we get into the topics, if we could just do a go round in the room, and then I'll ask those virtually to introduce themselves, starting with Jennifer.
Good morning. I'm Jennifer Weiss. I'm on the FASB staff.
Good morning. I'm Elizabeth Dietlein. I'm a FASB postgraduate technical assistant.
Hi, I'm John Schomburger. I'm the FASB postdoctoral fellow.
Good morning, Fred Cannon, FASB member.
Good morning. My name is Chris Drula. I'm the Senior Vice President of Financial Standards at NAREIT.
Good morning. Joyce Joseph, FASB member.
Good morning. Blake Collins, partner at Connor Group.
Chad Soares, partner at PricewaterhouseCoopers.
Ryan Brady, partner at Grant Thornton.
Shandy Smith, Senior Investor Liaison at the FASB.
Hillary Salo, FASB Vice Chair.
Sean Husband, Walmart.
Mike Chang, Frazier and Dieter, and PCC or Private Company Council member.
Heather Jossam, PCAB, Office of the Chief Auditor.
David Gonzalez, Moody's.
Rich Jones, FASB Chair.
Jack Day, FASB Technical Director. Sean C. Martin, Securities and Exchange Commission.
Jeremy Simons, partner EY.
Kristen Bauer, partner at Deloitte.
Thomas Finito at BDO.
Scott Muir, partner at KPMG.
Will Goff, NextEra Energy.
Sue Cosper, FASB.
Rahul Gupta, Grant Thornton, partner, FinRec Chair.
Bob Ewell, IASB member.
Christine Bodison, FASB.
Tom Grosskopf, Assurance Service Line Leader for Barnes Stennig and Technical Director for AICPA CPEA.
Steve Rivera, retired Vice President, Johnson & Johnson.
Nellie Debler, FASB Deputy Technical Director.
Connor Wilson, FASB Postgraduate Technical Assistant.
Lauren Motley, FASB Technical Staff.
Ashley Allen, FASB Practice Fellow. Great. And online, Nate?
Yeah, Nate Ziegler, Bank of America.
Ron?
Hi, everyone. Ron Graziano, Director of Accounting and Research at LSV Asset Management.
Brad?
Brad Rexroad, Say Research.
Derek?
Derek Christensen, accounting faculty at the University of Oregon.
Marcia?
Marcia Hunt, FASB member.
And Chris? You're on mute, Chris.
Whoops. I'm sorry. Chris Roberge, FASB staff.
Terrific. So with that, just a few administrative items. First of all, we're here to listen to you. So I'm hoping that a lot of people will get into the discussion to join the discussion. If you could just flip your name tags over if you're in this room, and we'll add you to the queue if it gets more active. And then online, if you could use the raise your hand feature. If you can't figure out that feature, just physically raise your hand and we'll call on you in the order that we see you. If you want to jump in directly on point, you can do the double hand signal and we'll try to get you in earlier on the queue as well. To talk on the microphone, you guys already figured it out. Push to talk, push to turn it off after you're done. Otherwise, the camera will stay on you. And I just also did want to mention that for the meeting participants, we will provide CPE for those that are interested in receiving CPE for today's meeting. And that goes for both online and in-person participants. So turning really to the purpose of today's roundtable and realizing that many of you have been involved in the process throughout. Some of you may have come in and later in after the leases had been released and have participated and provided input throughout. But this roundtable is really a very important part of our process. We had a board meeting last week to talk about the culmination of the information that we've gathered from our PIR process. And today's discussion is really an important part of that, both to see your reaction to what we've learned along the way and see if you have additional input or discussion observations. The staff's focus during our post-implementation PIR process is really focused on evaluating whether the standard is accomplished its stated purpose, to evaluate the costs and benefits of the standard, and we'll walk through what the board's expectations of both the benefits were and the costs were at the time the standard was issued. And then also, very importantly, to provide feedback on our standard setting process. The PIR process started in 2016 when the Leases standard was issued, and it's expected to wrap up with a report that will be sent to the standard setting oversight process committee of the Financial Accounting Foundation later this year. Today, we plan to share with you, and you have some of that in your materials, but to share with you what we've learned so far and really to hear your input on those observations as well. So over the next 4 hours, we've divided this discussion up into a few different sections. The first 2 sections will focus on the costs and the benefits that the board expected when they set the standard, and then how the actual experiences, the information that we've received along the way from the post-implementation review, the actual experiences compare to the expectations, and to hear your discussion on that aspect. Then in the afternoon, we have a third section that's focused on specific areas of the guidance that stakeholders have said are challenging throughout the PIR process, and have an opportunity for input on that. And then the last section will focus on our standard setting process and will include feedback from the standard setting process as well as the PIR process. So with that, we'll go and start with the expected benefits of the standard, and I'll turn it over to Lauren to provide introduction.
Thank you, Alicia. Good morning, everyone, once again. So the purpose of this first session is to summarize the expected benefits of the Leases standard at issuance and to provide an overview of what the staff has learned about the actual benefits as part of the PIR process, and obtain feedback from you participants today about your views about the expected and actual benefits of the standard. The primary objective of the Leases standard was to increase transparency and comparability among organizations by recognizing lease assets and lease liabilities on the balance sheet and disclosing key information about leasing arrangements. At issuance, the board expected the following primary benefits from lessees. 1, a more faithful representation of the rights and obligations arising from leases. And 2, an improvement to the understanding comparability of lessees' financial commitments, regardless of the manner that they chose to finance the assets used in their business. The board also acknowledged at issuance that users' leasing informational needs may vary depending on the type of user they are, for example, credit analysts or an equity analyst, and the industry in which an entity operates. The board further acknowledged that some users would continue to adjust the reported right of use assets and lease liabilities in their analysis. Throughout the PIR, the staff has conducted outreach with both public and non-public company users to determine whether the Leases standard met its objective. Many investors generally agreed that the financial reporting under the Leases standard provides decision useful information. Investor feedback was based on whether and how investors use the lease liability ROU asset, the disclosures as part of their analysis. As it relates to the lease liability, feedback from investors on the usefulness of the reported lease liability was mixed. Many investors indicated that they used the reported lease liability in their analysis with minimal or no adjustments. Others indicate that they use the reported lease liability among other factors and make adjustments in their analysis. while many others indicated that they do not use the reported lease liability, and they continue to estimate a lease liability using another method such as a rent multiple approach. Regarding the ROU asset, some investors indicated that they use the reported right-of-use asset in their models to evaluate metrics. Most other investors stated that they have minimal, if any, consideration of the ROU assets in their analysis, citing a lack of context for what that amount represents. With respect to the income statement effects of the leases standard, many investors stated a preference for the leases standard expense recognition approach of a single lease cost for operating leases, as opposed to separate interest and amortization that would result from finance lease accounting. Those users indicated that they consider operating leases to represent an operating activity and not a financing activity, and therefore support the different income statement reporting for operating and finance leases. Almost all investors providing feedback noted that the disclosures are an improvement to legacy GAAP, and that the disclosures provided, such as the components of a lease cost and the weighted average discount rate and the remaining lease term, are helpful in their analysis and are a key benefit of the standard. As part of the PIR, the staff also reviewed 33 academic studies about the financial reporting effects of the leases standard for lessees, which generally indicated that the leases standard provides a more faithful representation of the rights and the obligations arising from lease transactions, and that it does improve comparability and users' understanding of entities' financial commitments. While feedback from users from a lesser perspective has been limited, investors generally agreed that lesser financial statement information represents the economics of lesser's leasing arrangements. And so with that, I'll turn it back to Alicia, and we can facilitate the discussion on questions 1, 2, and 3.
Great. Thank you, Lauren. So to start out, the discussion that we're looking to draw out here is really comparison of the expected benefits versus the actual benefits, as well as if you have observations on what the staff has gone through about the feedback received about the benefits. And then also, importantly, if there's other benefits that that you've identified that were not expected by the board, we'd certainly like to hear those as well. So I'd like to open it up for observations on any of those 3 aspects, either lessee, lessor, or otherwise. So does anyone want to start us off on this question or this set of questions? David? Thank you.
I mean, this is something we've said a bunch of times, but the benefits are in the disclosure and showing the different disclosures and the different types of leases. And I will say it again, and I'll keep saying it forever, disaggregation, and having the disaggregation of your lease types and the different types of recognition on the income statement is really helpful. There was a lot of information provided, especially about variable lease structures that we weren't really fully capturing maybe previously. And so that information was really good. The cash flow information and presentation and everything in the disclosure, I think is a really nice disclosure and a huge improvement over the prior lease disclosures.
Thanks, David. Observations from Ron?
Yes. So I'll just kind of go through some of the points that were raised in terms of like the expected benefits. Liability, I think is the liability and the asset gives comparability. So I know some of the feedback is there could be improvement, and some investors might still use a multiple of rent or so forth. And I can kind of get into some of the technical aspects of that later, but I think just to begin, having the liability and the asset on the balance sheet to provide some starting point of comparability on how companies, use assets to generate cash flows and use, liabilities in terms of lease liabilities is helpful. The income statement is a good presentation, using rent as opposed to the IFRS method, I think is much better. So that's been, kind of an easy transition to just keep having the rent and in terms of the income statement. That also carries over to the cash flow statement. Another problem with the IFRS approach is it kind of distorts the cash flow statement. So instead of having rent in the operating section, you now have amortization and sometimes interest, and then the payment is down in financing. So anyone that looks at EBITDA or looks at free cash flow, that causes big problems with comparability before and after, and then also comparable to US GAAP. The one complaint I'll have about the cash flow statement, the presentation could be a little cumbersome on the US GAAP side. The dual approach where you have the change in the lease asset, the amortization, and the change in the liability separately disclosed on the cash flow statement, that can cause some problems if you're looking at individual line items on the cash flow statement. And then the disclosure, I would say, yes, it just kind of echo the other comments, the variable lease and some of the new disclosure items are very good. The one item, and again, I'll kind of save some of this for later maybe, is the life of the leased asset. The remaining weighted average lease life is good, but would really be helpful to investors and would get around some of these problems with the lease liabilities, the economic life or the type of assets that the company is actually leasing. So really what investors want to know is you're leasing a warehouse and maybe the remaining life is 2 years, but we need to know that the economic life of that warehouse is, say, 30 years, because then we can make adjustments for that. And then the one last comment here is just one of the expected benefits was, I think it was the last one, result in fewer opportunities to structure leasing transactions. And I think from my perspective, I didn't see a change in behavior before and after the lease standard. Like I didn't think that companies were actually, using the accounting standards to dictate their behavior. Most investors, all credit rating agencies, even before the standard, were making this adjustment anyway. So I don't know if that was an expected benefit, specifically, again, changing behavior.
Thanks, Ron. Derek?
Hey, thanks for putting together the materials. They were great, by the way. And just to maybe add a little bit to Ron's point. So obviously I wasn't involved in the decision making at any companies, but from an academic research standpoint, there are a handful of studies that show certain firms that were very exposed to the lease standard did indeed start moving away from operating leases towards purchases and finance leases. There's a variety out there. I think one that's pretty poignant that I think's been in the media a little bit is there was a study about the aircraft industry, and that has very granular detail about what aircraft are owned or leased because of FAA reporting regulations. And there's some strong evidence that firms started actually purchasing more aircrafts and letting some of their operating leases expire. So just something for the board to consider as they go through the PIR process.
Thanks, Derek. Sean?
Yeah, I can touch upon a couple of those from a preparer perspective. We did see in certain asset classes a change from operating leases to finance leases. I would probably just say more from, it feels like administrative company processes. The budget process for most companies to go through the capital approval process is different than the operating expense that you can manage in your own P&L. So if I have capital constraints self-imposed as a company, then, well, I can get an operating lease that goes through my own budget, and I can get more, assets to use and to generate my earnings or what I need to achieve through the operating path. Well, with the new standard, and that puts it all on the balance sheet anyway, well, then the incentive to be able to use an operating lease to go through your own P&L is removed. So we did see certain assets where the economics were actually stronger for that to get the use of that asset on a finance lease were better than the operating leases, but we had been using operating leases as a result. I think as a company, we would have said, hey, do what's the best economics so we get the best return. But we we found actually prior to adoption, once we learned the rules were going to change, we saw business operators going, oh, well, that's where it's going to go. And they started shifting. So I think interestingly, if you actually reversed and went right back to 840, I don't think we would actually change though, because I think now that that's come out and we've realized that's what people were doing, we would probably say, well, wait a minute. If they came back and said, well, now I want to go through operating, we probably would say, no, actually, you've already shown us now the economics were better for the finance leases. So make sure you go through capital. But we did find that that's a benefit that we definitely achieved. So certain asset classes significantly moved from an operating lease weighting to a finance lease weighting, which does have an economic benefit to us. One other benefit that's smaller, much smaller, in true return, but we'll hit the cost side of abstracting every lease we have, but at least once you've done that, we have noted certainly in the management of leases and also in the accounting for leases, it is nice with the need to capture these in systems and also the adjustments that come from things like remeasurement, reassessments. In the past on an operating lease, if that was just running through payments and accounts payable and we just paid the bills and it hit expense, if there was a change in that lease and somewhere 3 years later, someone asked, hey, what happened with that thing? All I know is I'm still paying that bill through AP at a different amount. So it's harder to know what changed in leases as you went in history. With the infrastructure we now have, really going back and be able to see what lease actions were taken, why were those taken, what changed. They're highly visible now for us to be able to go back and do analysis or be able to determine what the next step should be. So that's a benefit we saw from it as well.
Thanks, Sean. Stephen?
Sean, maybe to add to you, you kind of took a little bit of what I was going to say, but I think the word I'm looking for is accountability. I think from a preparer perspective, what we found is by having it on the balance sheet, I think there was more decision-making by management because of the fact that now they have to deal with something on the balance sheet. As you said, once you put it on the P&L, it goes into a budget, no one cares about it. But once it's on the balance sheet, it becomes a very different item, and I think management has to deal with it. Also, it's also, having these assets, there's also other commitments that we don't know about. There's also other hidden costs, right, that you have to deal with that no one talks about. So by having these operating leases off balance sheet, all of a sudden you have things that come up down the road, and also managers say, well, hold on, I didn't sign up for this. I didn't know I have to pay this later on. I didn't know I have to go back and revisit the lease at the end and put everything back, or all these other costs at the end. So that we're not really clear, especially with operating leases. So I think that by having this all on the balance sheet, I think it did give more transparency and also more accountability for management to make better decisions, as opposed to just having swept on the P&L as an operating lease. So I think there was definitely a benefit there.
Thanks, Stephen. Tom?
Thank you. So I wanted to make the point about the weighted average lease term and discount rate. In the private company space, some of the benefits are mitigated by confounds. Specifically that those rates are conflated with a risk-free rate that was artificially depressed at the transition date for private company with unrelated party discount rates, IBRs, and implied rates. And on the lease term side, the ability for the preparer, assuming proper process has been followed, to engineer their own lease term for related party leases under common control is conflated with, again, unrelated party leases for that calculation. My suggestion, because this has been an area of feedback from the private company community, would be to consider permitting explicit, specific lease terms. And so if you only have 3 leases, just say, here are the payments, here's the rate, and move forward in the term. As opposed to having to go through what many perceive in that space as busy work in determining what weighted averages are.
Thanks, Tom. Kristen?
Thanks, and thanks for the materials. It was a kind of a walk down memory lane of a lot of things and a lot of things that we've thought about for a number of years. Maybe to offer just a few things that, as I reflected, that I thought were also benefits that I didn't see particularly highlighted. First, leases is just like one chapter in a broader book. And so moving to control and the undercurrent of control in leasing, I think had a benefit because then you put it with revenue with consolidation, and sometimes there are crossover transactions. And so that control concept, I think, is a benefit. Speaking revenue to leases, I think there's a lot of contracts that had overlap services. So the interconnection between leasing and revenue, I continue to find that to be a really important part of what the board did. Also would highlight the old GAAP had a distinction between real estate and equipment, and therefore there's a scoping change, and you had to make that decision. And so they've, with the new standard, all assets are considered equal. And so I think there is some benefit of not having to do a scoping and have one thing do one aspect versus another. So maybe just raise a few of those things.
Sorry. Oh, Jeremy, sorry.
Yeah, and maybe just to keep going with a theme, I think Kristen maybe started. I think there were some secondary or maybe tertiary benefits by having 842 address some of the 840 problem areas around build-to-suit accounting, sale-leaseback accounting. That guidance was really difficult to navigate under ASC 840, provided some results that I don't think preparers or investors really appreciated. And then modification accounting is another topic I'll mention. The 840 guidance was difficult to navigate. It's operationally challenging to navigate today under 842, but at least technically speaking, I think it's more digestible. I just wonder without 842 if those items under 840 would have been addressed. And so I think it, again, secondary, maybe tertiary benefit of having 842 to have that cleanup.
Thanks, Jeremy. Scott?
Hi. First, I'll echo what Kristen and Jeremy just said. I do think it can be lost a little bit because 606 was adopted together with 842 in fundamentally the same time frame. What difficulties would have existed for lessors when we're talking about, oh, we didn't really mean to change lessor accounting, but many of the changes were made because 606 was coming. And if you were trying to apply 840, unadjusted together with 606, I think it would have created some of the difficulties that Kristen was referring to in terms of how do you allocate the modification guidance is aligned, the IDC versus contract acquisition cost. So I think that's useful. The other thing I thought I could add incrementally was I was trying to go back in time, Kristen's reference to a down memory lane. I was, of course, here on the staff in 2013 to 2015 working on this project. And I remembered the investor report that we put out. I think it was about mid-2015. And fortunately, I couldn't find a true copy of it, but some of it's burned in my brain. And it felt to me that I wasn't reading much different in either the PIR paper last week for the 9-3 meeting or the materials here that told me what we were hearing in 2015 didn't come to pass. In fact, when I read some of the quantitative descriptions of how investors are using it, it actually, to me, seemed potentially more positive than what we were expected by the feedback before the standard came out. And I think we heard some of that in the 2020 roundtable as well, from the perspective of how much users were actually making use of not only the disclosures, but using the actual recorded amounts as either a very good starting point or actually using it unadjusted. And some of those involved, I think, some populations that maybe said we likely weren't to do that and actually ended up doing that if you look back in time. So to me, right, the board made the cost benefit decision based on what they expected. We made the best effort we could to produce what that would be. And it seems to me it's actually exceeded what the expectation was rather than been a deficit.
Thanks, Scott. Chad?
I want to echo what Jeremy talked about in terms of build to suit. I spent years helping clients deal with build to suit, often not having thought about it initially, often getting tripped up on terms that were not necessarily economic terms, paying $1 of hard costs, for example. People really tripped up on very complicated guidance and found answers that were very punitive. So build to suit alone is a vast improvement, let alone sale-leaseback, et cetera. But having helped a number of companies deal with the adoption of lease accounting, and it's mentioned in here, that control and awareness of what we're doing commercially in transactions, I think is another benefit not to be not to be sort of underestimated. When I was dealing with, helping clients deal with this, they didn't realize the kinds of terms they were executing, the variety, the different languages, the local provisions that were in there that people didn't realize were they were residual value guarantees or what have you. Leases that expired, yet you continue to pay for that old equipment for months and months and months after the expiration date because you weren't aware it expired. The notion of a better controlled process and more institutional awareness of what we're agreeing to me, I think is a benefit beyond just the accounting benefit from it. It's a better control process, which I think, Sean, you made that comment earlier, and I would agree with that, actually.
Thanks, Chad. Any other observations about the benefits or questions from board members? Will?
Yeah, I think I'd also echo Sean's points around accountability within the business. And then I think, David sort of touched on, to kick us off, from a user perspective, in preparing for this, I sat down with my IR team, I sat down with my treasury team, and they are not getting questions from either debt investors or equity investors about, hey, we don't understand your disclosures, we don't understand what liabilities you have and how they roll off, et cetera. So, just taking that, it sort of tells me that the objective has been achieved. We're providing clear information to the use of our financial statements, and they're not confused by it. So it's, I think, from our perspective, it's been positive.
Thanks, Will. Mike?
Thanks. So, yeah, I mean, I think the unexpected, well, first I want to start off, none of the private companies I helped to implement, I think 842 enjoyed it. But on the other side of it, I think that accountability factor was a huge positive for them because there was a lot of stuff that they just didn't know were going on with their leasing arrangements. And I do echo the sale leaseback improvements in discussing, I think, with clients before and after 842. It's a lot easier to explain how that arrangement works and the economics of it. So I think there has been a lot of improvements and clarifications on certain transactions related to leasing.
Thanks, Mike. Ryan?
Thank you. Just want to make a point about the expected benefits in terms of reducing structuring opportunities. I think overall, obviously, the structuring opportunities to avoid on-balance sheet accounting for a lessee have been lessened in terms of, the operating leases being on balance sheet. But I think we have continued to see, I think, substantial amount of structuring efforts. It's just the levers to get to off-balance sheet accounting have changed. So in particular, we've seen some arrangements where, payments have been structured to include variability that would get you to a variable lease payment answer, where it's been important that the contract is not on the customer's balance sheet. And that may come up later when we talk about operational or application challenges, but I think it can be tricky to discern, I guess, true variability or variability related to the performance or use of the asset versus sort of protective variability, contingent payment adjustment clauses, that kind of thing. But we have seen in structuring in that area, and also in terms of, several people mentioned the built-to-suit guidance. I think there continue to be highly structured transactions that are designed to avoid lessee recognition of the construction project on their balance sheet. And so I think overall, probably the structuring opportunities have lessened, but I think to some extent it's just shifted maybe where the structuring is happening. I think there's still a motivation to avoid and opportunities to avoid on-balance sheet accounting. And I would also echo, I think, the points about the built-to-suit accounting. I think, like Chad, a lot of the questions we would get in our national office had to do with application of built-to-suit or sale and leaseback transactions. And we spent a lot of time navigating the built-to-suit guidance and talking to people, some, interesting discussions with like building engineers and construction contractors, understanding, really the nature of the construction activities, as opposed to really focusing on control, which I think the new model does a good job of.
Great, thanks. Derek?
Sorry, I was muted. Thanks, Alicia. Just jumping on to Ryan's point there. Again, this is just sort of broadly from an academic research perspective, but there are a handful of studies that suggest that firms are engaging in more contracts that contain variable lease payments, more contracts that fall below that short-term lease exception. And then one point that Ryan didn't touch on, but I think is potentially present, is firms are actually seem to be reducing their lease terms to make the liability that ultimately goes on the balance sheet smaller. And I think this goes back to something that Ron mentioned at the beginning. As an investor, when you're trying to understand the economic life and these terms are getting shorter, that I think that becomes more challenging because the difference between the weighted average lease term that firms are disclosing and the economics of the asset that they're leasing becomes bigger. So just a few things to keep in mind.
Thanks, Derek. Tom and then Nate.
Thank you. So I acknowledge the points about the operational benefits and the management benefits, and certainly think I've seen that with larger private companies. I would just submit with smaller private companies that cost is very regressive, and they may not feel the same way with the cost benefit trade-off, and that to the extent it's considered by the board, and I don't know if it is or it isn't, I get mixed messages on that. The smaller private companies and the regressiveness of that cost needs to be thought about if it's considered as a benefit.
Thanks, Tom. Nate?
Yeah, I guess first would echo the other preparers' comments about just generally there's more attention given to the lease accounting today than there was previously. But maybe incrementally regarding build to suit, as a significant lessor, we definitely do see our clients looking to structure transactions in build to suit arrangements where they're trying to get potentially off balance sheet treatment. And quite frankly, we're trying to get loan accounting. As a bank, we want to, have that as a lease or a loan and not have those assets on balance sheet. So definitely still prevalent, but I mean, that's always going to be a factor. I don't know that I view that as a negative, and probably a positive in that there's probably less structuring or taking advantage of the accounting guidance than perhaps there was under the previous model.
Thanks, Nate. Go ahead, Thomas.
Yeah, so I'm not a user, but it seems like we've got some pretty good positive feedback this morning from a user perspective about the benefits of the leases standard. The paper talked also about some mixed feedback, which I think was anticipated at the time because you can't satisfy all of the users' needs. But like I like what Ron said, being that leases on balance sheet is a starting point. And depending on the user's needs, there's some footnote disclosures on the weighted average discount rate, lease term, and so on and so forth that essentially helps you bridge the gap between user needs and what's in US GAAP. Just like variable lease costs, you have that in the footnotes as well. So I think it's a good starting point. There's good disclosures to bridge the gap. I echo the comments made about there's better accountability, better handle on leases. And I also want to echo my colleagues, practitioners' comments about lease modifications, sell leasebacks being much better than in prior GAAP. I also like the comment Christine made about this notion that to control an asset or to control an entity, there's some commonality. You need economics benefit and you need power as well. So this alignment across topics, in my mind, is very useful.
Thanks, Thomas. Any questions from board members about the benefits that weren't covered yet? Or that you want to ask us follow-up? No. Okay. Well, thank you all for the input on this first section. I think that's a very, very important and helpful input along the way. So with that, we'd like to turn it over to the other side of the equation and looking at the expected costs and actual costs. And to tee that up, Jennifer's going to start us off.
Thanks, Alicia. So in topic 2, we will discuss the cost of applying the leases standard. Upon issuance, the board expected that certain lessees would incur additional costs as a result of initially applying the leases standard. For example, educating employees, identifying all leases, and implementing new processes and internal controls. However, the board also expected that most lessees would not have to implement significant new systems to adopt the guidance based on stakeholder feedback, primarily because many of the concepts in the leases standard are similar to those in legacy GAAP.
For lessor accounting, the board expected that lessors would incur minimal cost to implement the Leases standard because lessor accounting was intended to be largely unchanged from legacy GAAP and intended to align certain aspects with the revenue guidance in Topic 606. Stakeholder feedback obtained on cost is included in paragraphs 31 to 38 of your materials, which I will briefly summarize. Overall, many stakeholders indicated that their ability to effectively adopt the Leases standard by its effective date was inhibited by resource constraints such as limited accounting personnel and newly developed lease accounting systems that were not ready or available to the market at the time of the effective date or in a sufficient manner or time to prepare for the adoption. Certain academic studies demonstrated that many entities updated their systems and processes to comply with the Leases standard. Some stakeholders noted that recognizing operating leases on their balance sheet brought enhanced rigor to fundamental aspects of the Leases standard that were relatively unchanged from legacy GAAP, resulting in preparers establishing more robust internal controls and processes. Non-public entity stakeholders communicated that the challenges of adopting the Leases standard were magnified for those entities. And lastly, lessor stakeholders indicated that they generally did not experience significant challenges or incur significant overall costs to comply with the Leases standard. So in Topic 2, we are seeking feedback from participants on the expected and actual type or nature of costs from applying the Leases standard. So for example, systems, personnel. And then in the next topic, Topic 3, we will discuss the costs associated with applying specific areas of the Leases standard. So with that, I'll turn it back to Alicia to facilitate discussion questions 4 and 5.
Great, thanks, Jennifer. And just to observe, in part because of when this standard was implemented initially for public companies versus private companies, for some, it may be going back farther on that initial application than it is for others. But really would like to hear your input both about the how the actual costs went out, systems challenges and other aspects, and whether the actual costs that we've captured based on the stakeholder input that we've received real time as well as ongoing basis is consistent with your observations. So with that, open it up to any observations on questions 4 or 5. Sean?
So we thought it was fairly inexpensive. No, I figured you'd know what I was going to say, so I try and go the other direction. I guess I'll also highlight, I didn't do it in the intro, but I was also the chair of our Leases working group for Financial Executive International, so the Fortune 50, let's say, large company group. So, bringing their viewpoints as well. I think the board captured, the staff captured, the feedback already. I won't go into depth on costs of, yes, it took more resources than you would have expected. It took more systems implementations. You needed consultants, you had to invest in systems. So it was significantly expensive adoption for us and anybody with a significant number of leases. So I wouldn't say that you have to be a large company to have a lot of leases, but anybody with a large number of leases, I don't know how you would have done this at a low cost. And resources, I also think a couple aspects worth highlighting there, though, on the resource constraints is the entire world was adopting, right? Because it wasn't just US GAAP, IFRS came out. So the entire world was trying to adopt at the same time. So if you're trying to add headcount in your space, you were now competing against the world's headcount. And then if you were trying to get consultants to help because you didn't have the headcount, well, you're competing against the world for consultants. Consultants started running short. And then if you're doing a systems implementation, thankfully, we're Fortune 50. So we got the systems people first. But I've always felt, for our private company friends here or the smaller mid-sized companies, systems implementers became scarce. So the firms that would implement their own software programs ran out of people who could implement. So they turned it over to the public accounting, picked up a lot of it, but they'd go to training and then go try and implement a system and did a fantastic job, guys. But it was that became a challenge. So if you were in line, getting somebody who could implement your system became a problem. And then the level of quality at that point, you're not getting people who've been implementing that tool. And let's recognize every single lease system was built from largely scratch because they didn't exist to do the standard. So they were building the systems while they were implementing the systems with people who hadn't implemented it before. So just trying to paint the landscape there. If I get to what do you do different, I think there certainly was. I mean, I applaud the FASB and the staff, and this will probably come up somewhere else in points I'll make. I do think this organization does a fantastic job of listening to your stakeholders and who's out there. You asked preparers how hard this would be. I wasn't here when the standard was adopted. I joined after. I don't know how you got the feedback you did. I could get into that, which I probably will later when you get to the what would we do different there. But that created a timeline based on the feedback you got that then turned into I think everybody from there tried to do the best they could to try and implement within a timeline that was thankfully moved and practical expedience given. But it still became a challenge. And I think as preparers, though, we also didn't want to tell you, can you wait 7 years? We know you wouldn't want to do that. So I think everybody tried to do their best from there. But it did drive a high cost environment to implement.
Thank you, Sean. Chris?
Thanks, Alicia. So from a real estate lessor perspective, the feedback I received from my members was very consistent with what the staff said of the cost being minimal upon adoption for real estate lessors.
Thanks, Chris. Blake?
Yeah, so we did a lot of system implementations for companies of various sizes. And I think the initial feedback that we got was that, there was such a massive reliance on Excel, honestly, with previous accounting standards under 840. And companies would just do deferred rent schedules and calculate straight line expense. And it was relatively simple under that approach, I would say, even for disclosure purposes to aggregate everything together. And so we had a lot of clients that initially, maybe they only had 15, 20 leases and they're like, we're just going to do this in Excel and just keep doing it the way that we've been doing it. But I think companies have realized the burden of just maintaining those Excel schedules and teaching people how to use those Excel schedules and just continuing to get it right, basically, especially from a disclosure aggregation perspective. It just gets really burdensome. And so I think a lot of our clients have said that the cost of implementing 842 is, I think, more than they've expected because they've gotten to the point where they've realized they don't have the resources and they need a system to manage these leases, and which I think is a good thing, honestly. I think it helps data accuracy. It helps with just making sure that your lease portfolio is correct from an accounting perspective. But it's definitely a cost, I think, above and beyond what a lot of our companies that we've worked with have expected.
Thank you. Chad?
Yeah, anecdotally, I'm not a systems implementer, so just from what I observed, I think Sean made a great point that you had to get in line. If you weren't Fortune 50, there were a lot of companies who had to get in line for a system. And many times when you're sitting in demos with a system provider, they were talking about what it would be, not what it was, right? So you were buying on what you expected to be there. And I would observe one of the points of feedback that we got back was there are some people who made calls that they changed. They may not have changed for the initial adoption, but we have heard anecdotally, I wouldn't say it's the majority, but there were people who made a decision of what system they wanted. And when they sort of lived in that system for a little while, they realized that wasn't the right system for them. And they not only implemented a system, but then they potentially had to move to a new system as the market sort of shook out and as the software tools got developed and people had a greater awareness of the pluses and minuses. Every system had a plus and minus. And sometimes there were changes made, which I simply throw that out there from a cost perspective. Obviously, it's expensive to implement once. It's more expensive to have to implement again if it's not working for you.
Thanks, Chad. Will?
Well, that was a perfect tee up because I'm one of those people. So yeah, look, I think, Sean said it right. The software solutions didn't exist. They were being built on the fly and there was a lot of promises going on. And then when you live in it for a few years, sometimes those promises don't materialize. And so we are going through that right now where I'm transitioning from one software that was implemented. It's okay, but it's not delivering what I really need. And as we've said, there is more emphasis on leases around organizations. There is a need to not be in Excel and to manage things properly. And so I am going into a second implementation to try and actually capture what I need and the value for my team, because there was a manual lift to implement, but the ongoing nature of the work, it's the right work, but I need to do it in an efficient way. And so I think the fact that the tools and that the software wasn't ready has been a challenge across many companies. And I'm not quite as big as Walmart, but was fairly high up the list of people in the line for resources. And it was not about the quality of resource, it was that the products weren't there yet. So it's not a criticism of the staff. I think we didn't want to wait for the standard, but I think for the software developers, it was a sort of an awakening around the pace at which they need to move sometimes to develop products, and it just wasn't there in this case.
Thanks, Will. Mike?
Yeah, I think the paper did a great job articulating the costs and the unexpected effort, I guess. I will echo the software concerns. I think when I got out into practice, I was surprised that the plane was being built, as we were flying, which makes sense, but this was already a standard that's been out for a while. And I think the first thing I saw was just incorrect accounting, like in calculations on how you would stuff from just how you account for modifications, the fact that there's partial terminations. I mean, there's still probably software out there that is not getting that correct. So I think that was a big cost. And then when people realized even the accounting is incorrect and transitioning, that was tough and probably unexpected, along with probably other things that they were promised. So I think that was one thing that I didn't realize until I went into practice.
Nate?
Yeah, thanks. Maybe I'd just add a couple of things. So obviously the implementation costs were significant. I won't belabor that point, but I think something that has been unexpected for us as post-implementation cost is because of all the system providers that I guess sprouted up or developed these systems new at the time of adoption. Now what we've seen is there's been some consolidation in the service providers. And so our hand was kind of forced when our system provider was sold. They sold their software application, one of the big four. I won't mention any names. They sold their software application to a third party, and that third party couldn't meet our data requirements for privacy. And so our hand was forced that we had to switch system providers. And because of the timing, we had to have an interim manual solution. And it's been very costly, quite frankly. And now we're trying to onboard to a new system. So that's been an unexpected challenge, is just dealing with some of the consolidation in the industry for the system providers. Then something else that we've observed, and this is relatively unique to the financial services industry and regulated institutions, is we have capital that we have to manage on our balance sheet, and so all the assets, the right of use assets that come on our balance sheet, they draw a capital charge, and so that is a actual cost that we incur for leases that they're 100% risk weighted for capital purposes, so that draws around 11% capital that we have to hold back for every dollar of right of use asset. So that's been a cost for us.
Thanks, Nate. David and then Rich.
Yeah, I think we've discussed on the user side the cost. I mean, obviously, number one, for users like ourselves that use IFRS and US GAAP is the divergence that you have. EBITDA on a reported basis have a miles wide gap on reported issue because of leases. That's one of our biggest things. But I think that was very clear, and that's what we've discussed over and over again. Some of the things as we've gone through in having adoption, one of the other things that is more of a cost on understanding, just as a little bit of background, we've always put leases on the balance sheet. We calculated our own. We had a rent multiple and a discount based on the future commitments table. So we've always put it on. At transition for public companies, we had really good explanations as to why we had differences in our estimation versus what was in the financial statements because of disclosure, the leases, the lease terms, the commitments table. Maybe it was minimum contract and not the accounting commitment table. And we were able to see and explain those things through. But one of the costs that, I mean, I don't know how, foreseeable it is the discount rate and the change once we got to private companies. Now we're dealing with something entirely different that is just this rate changed. And that's not something as tangible to hold on to when you're transitioning and understanding the explanation. And we have companies that are transitioning that are private companies and their discount rate is lower than our, larger companies that wouldn't really be expected. And then we had this kind of gap in comparability where we can compare our private companies and we can compare our public companies, but when we look across them, there's a little bit of a gap there. And that was a little bit definitely not expected because nobody expected like the gaps and the timing differences. It was just something that causes us a lot more time to investigate and explain and get our heads around. And then when we point to the discount rate, there really isn't much we can do with that analytically. And the other one that we spend a lot of time on that I don't believe, it's been a while, but I don't believe was a problem under the old accounting. We always talk about the operating cash flow statement and how essentially there are no rules from top to bottom. And this one created a lot more confusion in the way it's presented in operating cash flow, especially if you look at metrics like FFO or CFO pre-working capital, because there's a lot more confusing lines that, while technically correct, are not accurate, I would say. But, you have non-cash lease amortization. That's your full rent expense. And it's no longer this like deferred rent type thing. And it creates a lot of confusion on the cash flow statement so that it gets added back. And essentially we get FFO that has no lease costs in it because it got added back as a non-cash lease amortization or right of use amortization, which is technically true. And then all the outflow goes down and changes in working capital, where that number used to be a more valuable sort of non-cash lease number. I'm paying more than I'm expensing on a straight line basis. That kind of went away. But we see tons of variation in how this is presented. We move everything down and have to put everything in working capital because we remove the expense anyway, because we call it debt. So we have to have that set up in that way. But those were two things that kind of came out, and over time we weren't really expecting, and we had to build, processes and adjustments to fix at least the cash flow stuff to make sure that we have everything in the same place for all companies.
Thanks, David. Rich?
So at the start, when we were talking about benefits, I heard one of the benefits was getting operating leases effectively into a system and controlled, but I didn't hear it in costs here. And I would have assumed that either identifying what executory contracts were leases and also taking the operating lease footnote, which I view as an off-system disclosure effectively, and having to pull that information on system was likely a significant effort for some, but I didn't hear that. And the reason I ask that is most footnotes are about the accounting you've done, but when you look at things like the operating lease disclosure, it's about accounting you haven't done yet, right? It's simply pulling information and assembling it. And that may be helpful for us as a board too going forward.
Thanks, Rich. Tom?
I guess a couple points. First, on the staff memo, I'd also compliment the June PCC working group memo on leases, which I think is an accurate depiction of the current state of play with private companies on cost. And I'll point to a couple points. The fixed cost element for private companies, especially smaller private companies, the minimums that software companies charge, the need for external resources is the element of the regressiveness of costs, especially for the smaller private companies. That is painful. The other thing, in rewinding the tape on the process, is the messaging was hard for private companies, even after the public companies went through it. I didn't see in either the June PCC memo or the memo for this meeting any mention of the display approach that was just not realistic unless you had, just one maybe lease or two at the most. But conversely, the software vendors were perhaps conveying a need for their product that may not have been necessary as well. So those entities, the private companies, were kind of caught in the middle there on what exactly to do. And that was a frustration that I wanted to convey as well.
Thanks, Tom. Ron?
Yeah, so I was just going to follow up on David's points from a investor, use case example. There are costs to, anytime there's a new standard, to understand how exactly the data will be presented. And then secondly, how the data providers might provide that data could be, very different given the different sources of data providers you might use. And I would also say internationally, it's still, I would classify it as worse. We're still cleaning up items internationally, and just the way the data is presented, and cleaning up some of the lease accounting adjustments. And then the other point is the cash flow is what I mentioned and David mentioned. I just wonder from the preparer standpoint and from the FASB standpoint, has there been feedback on this? Is it something that will be looked at? So again, the main point is the cash flow statement, the operating section, it is okay compared to IFRS. The net effect is you're capturing most of the cost of the lease in the operating section. It's just the presentation of it could be confusing and different across companies. So I was just wondering if there was any other feedback on that from the preparer side or FASB.
Thanks, Ron. I have Sean, and then if there's any other observations to Ron's question about preparer feedback on the cash flow, I'd be interested in that, as well as Rich's observation about off to on balance sheet.
Yeah, I can provide some color on the question of the costs around operating lease change. I think the comments we probably were saying, we're just assuming that was part of the resource and system implementation. That's baked in, but it's a fair point. And I guess I also hit on I'm not sure where you got preparer feedback, that it wouldn't be a significant investment. But to hit those two together, someone hit earlier that, yes, operating in leases in the past, I could just make payments and code the invoice to directly pay to the lease expense account. So most operating leases, it was just code the invoice and you're done. I don't have to do lease accounting. And then if there was a straight line for those leases, I go to Excel, I add one row and I put in months and years and dollar amounts and take the sum of the column. There's my lease adjustment. Operating lease accounting, easy. For finance leases, I need an Excel tab for that lease. And okay, I'm going to create a tab for each of my finance leases. So if you have tens of thousands of those, then you probably had a tougher time in Excel, but that was doable. So if I just would have read the exposure draft at the time, and if you tell me that simply every operating lease now is going to need to be able to do a calculation that isn't just straight line rent, pay the invoice. I can't pay the invoice anymore. I need to go do math and determine for that single lease expense, how much of the asset's going to have to be amortized and how much of that liability is going to need to go away through one line item in the P&L. Oh, wait a minute. So now I'm probably going to need that Excel tab for every single operating lease. Well, that alone now tells me, boy, I don't think that's going to be a SOX process that's sustainable through Excel. So it drives me to system. But then you tell me, oh, by the way, if you're going to do a reclassification or a remeasurement, reassessment, modification, any kind of change to that, you're going to need to be able to take where that balance is at that point, do a fair value or a lease classification test at that point in time. So I'm going to need to know, well, do I have any prepayments, any incentives on that lease, any payments earlier in the lease that weren't straight line yet? Well, I'm going to need to calculate an existing number then that I'll add into the future cash flows, net present value, and do another class in Excel. Okay, that drives me to a system. And then, I got to do FX. And if the lease currency versus the functional currency, because I'm in a foreign market, to the reporting currency are different, I got to trace FX through that whole thing for this Excel spreadsheet tab. If I'm in IFRS, I've got to do that for a whole nother spreadsheet because that's not going to be the same lease. And then I'm going to have to do an IFRS to US GAAP reconciliation at some point. I could keep going. I'll stop. I don't know how you do that without a system if I just read the standard. So yes, I would have told you that's going to take systems. I'm not going to do that through Excel for any one of those reasons. Oh, wait, I got to throw one more. The weighted average discount rate and weighted average lease term. That's every single lease now. I've got to know what that number is, and I've got to have a dividend that's going to be based on the current balance sheet date. Wait, I can't do that on an annual exercise anymore because I have to go get a number for every single one of our 20,000 some leases, right? That's a system. So yes, we had to go get an army. I use that term probably realistically, to go look at every contract we have, because in the past, I could just code those to lease expense. Or honestly, if you didn't catch that and it was going through some other piece of the P&L, the income statement was still right. So the industry viewpoints of how great was that in contractual commitments is outside the footnotes. It's sitting in the other part of the SEC filing. So yeah, how great did that need to be? But now all of a sudden I'm putting on a balance sheet. I got to make sure I have all my leases. So I had to go through an entire contract analysis and look at all our contracts and say, are these leases or not leases? So I can get the lease component pulled out of there. Then you have to do a whole determination of, are you going to combine the lease or non-lease, go abstract 64 probably key fields we had for every single lease and get those into a system, and then be able to now go, by the way, none of the systems could do the work yet. So we had to help them build systems and do accounting for it and then get them all in. So yes, the answer to your question would have been operating leases were a significant investment to maintain that classification type versus having finance leases. So the feedback you were given that, hey, we should keep operating leases because we already have processes for that. I don't know how on earth that ever made sense, because you did not have processes for everything I just described.
Thank you. Kristen?
Thanks, Sean. I'm not sure that I'll do it justice, but I think, it was very clear as we started looking at that disclosure, what practices had developed. And remember 1976 and people started doing things. And I think they in good intent, they tried to make it the most current amount that they would need to pay, which came from an invoice, but that didn't separate lease components. It didn't deal with updating the index or rate, and could you do that? And so there were a lot of things and practices that sort of came to light. And it's not, I don't think it was like, sure, there maybe have been missing leases in some immaterial aspects, but there were just a lot of precision with respect to calculations and things that Sean just did a fantastic job illustrating and explaining as to how to get to all the elements of the thing that you are now going to recognize and measure. And some of that effort just was not present historically in a disclosure.
Thanks, Kristen. Tom?
Yeah, I just want to be incremental on the points that have been raised about differences between IFRS and US GAAP. And then in the private company space, you need to add IFRS for SMEs, FRF for SMEs, tax basis. And now the dynamic is we've got all different accounting depending on which framework you're using.
Thanks, Tom. Chad?
Yeah, Sean, I think you summarized the issues very well. What I just want to comment on, and I think everybody in this room knows this, is we keep talking about leases and the challenges of leases, and everybody's a different image in their mind. Maybe it's an airplane lease, maybe it's a real estate lease, but I've tended to find that embedded leases were always something we had to look for, to the point of, did they often kick out a different accounting result if there was a lease or there was not a lease? Maybe not. Maybe you have some disclosure differences, but the measurement was largely on point. I think the shift to on-balance sheet made a real focus on those on-balance sheet leases. And I think that the confluence of big, complex, multi-component, both lease, non-lease services, what have you, added a degree of complexity for people who have those. The companies who are dealing with big implementations of cloud infrastructure and so on and so forth are really wrestling with the challenges of control and so on and so forth today. So it's a smaller subset of people, but I would also layer on maybe less system driven, but lots of complexity inherent in unbundling those arrangements because they're often very big dollars. they're bespoke to a particular arrangement, and they often contain multiple different things in there that you have to deal with. And by the way, they're often revisited with regularity, so you continue to have to evaluate them through the life of those arrangements because of the reassessment guidance and so on. So I simply want to mention embedded leases because I do think the questions that bubble up to us, they often are embedded leases or big complex arrangements with multiple components.
Thanks, Chad. Scott?
Just a few things to build on. I mean, I guess, I do think it's important. Sean was describing, I wasn't there. I don't know what the feedback we were getting. I do think the basis and other places of the standard highlight what the feedback was. I think we as a system, the accounting system as a whole, I think it's important to recognize that we do need to look at if we conclude that leases need to go on balance sheet and the disclosures needed to improve. View that as the minimum standard, that even reason why to issue a new standard. I think the board did everything it possibly could to listen to everybody who told them this is the cheapest way to do it. Okay, if you accept that that has to happen. Now, I agree that some might in hindsight disagree with that decision. That was a debate. I remember going back in time and looking at accounting research studies from 1962 that were in the FASB library. You could have taken those studies, replaced them with some of the staff papers that happened at the time, switched them, and you wouldn't know which one was written in 1962 and which one was written in 2013 because the arguments haven't really changed over time. So it remains a judgment that you can't tell somebody they're right or wrong if they believe, yes, leases belong on balance sheet or no, they don't. But once you've concluded that they did belong on balance sheet and disclosures needed to be improved, which seemingly they have been, the board went out of its way to take the cheapest approach that they were being told by every preparer group that came through the doors, and there were many. Pick your every 3-letter and 4-letter lease-related organization, came through the door. Sue and I were likely in the room, and the board listened and tried to do the best. It ended up being that some of that advice was either wrong, or certain things were just misjudgments. I don't ascribe any motive to that, but the point being is, yes, it ended up being costly. We can't dispute that. But from a standard setting perspective, I can't go back in time and say the board should have done X, Y, and Z differently because they did sort of what the cheapest thing was that everybody told them to do. The last thing I'll add is I do think it's important, particularly since the cost thing does seem to talk about, what's going on now are recurring costs. I think a little bit to what Chad was saying, most of the questions that we're getting now in the national office are what I like to term almost a reversion to the mean. Up through the very last days of 840, we were still getting questions about new types of transactions of whether it had an embedded or was a lease overall. We were getting sale, lease back, and build to suit questions. And of course, we were always going to get questions when world events happen, like a Ukraine war or COVID or pick anything else. That really is the main substance of the questions we're getting today. The nuts and bolts of the standard have been figured out. The systems are set up the way they are, but we are getting the same sort of questions I would expect to still be getting under 840. People are always going to come to us and talk about complex accounting transactions. They're always going to come to us when something new exists, like just by way of example, we had questions about carbon sequestration ground leases. Are those leases, et cetera? That was going to be asked whether we were under 840 or under 842, other renewable energy scenarios. So I do think that we've sort of had a normalization has begun to occur to what we'll call a new normal.
Thanks, Scott. David?
Tom reminded me of another thing, but it's essentially just and there were comments earlier about IFRS, and we have mixed opinions on everything. We're mostly in the, pick a lane, put everything in the same place, and we could live with it and all of these differences. But one of the things with US GAAP still is we have this finance lease and operating lease that we've never distinguished between. In the past, we put them together, we treated them the same. All of us have been in a room where you move a couple dollars this way or a term that way and you get what you want. So it does leave, and we are still seeing lots of structuring opportunities. They're just different. It's just what you want. Do you want reported EBITDA pickup? Go to finance lease. Do you want something off of your covenant? Go to operating lease. And it just creates this variability. But on the plus side, the finance lease cash disclosure is great to have that go out, because we take our finance leases for IFRS and US GAAP, or for leases for IFRS and finance leases for US GAAP, and we move them into CapEx, because as was mentioned earlier by Ron, we do struggle with the idea of having free cash flow that is absent lease costs. And so that moves that into there, but we still have the two separate things. Good disclosure of the finance leases, but still there's this separation, still there's this room for structuring, and I still assume that there is accounting time taken and close process and audit on this distinguishment that really I think we could live without.
Thanks, David. Hillary?
And appreciate all the discussions related to cost and the feedback that we got at the time. A question I have is this project wasn't just one exposure draft, right? There were multiple exposure drafts. And when we think of getting feedback with regards to costs, that's one thing I think some of us have thought about is, was the feedback that we got related to costs somewhat impacted by the different options that were kind of before we got to the final option? Like, did people give us feedback that the cost related to applying what was the final decisions was less than what other options were? So maybe was it a little bit more rosy? I guess that's one of the things I kind of think about is if we would have just said, here's what the standard says, tell us the costs associated with it, would we have gotten the same feedback as what we did, which is multiple different options that may have been more costly. So by the time we got to the last option, it was less costly than others. So maybe there was a little bit more of a tendency to say, well, we think we can do this with existing systems because we had already been through a number of other options that were deemed to maybe be less operable. So just thinking about that from a future standard setting perspective and wondering if there are thoughts on that.
Thanks, Hillary. Ryan?
Yeah, I don't have thoughts on that particular question. I just wanted to offer a couple of things on like ongoing costs of applying the standard. I think we've gotten a lot of great feedback on implementation costs, system costs, and some of the reasons for, although you always had embedded leases and these things to think about, but why there were incremental costs associated with that. And these aren't necessarily issues that we get a lot in our national office, but I did have some discussions with our accounting advisory practice to see what they're seeing in terms of like what's costly for their clients that they're helping with Topic 842 issues. A few things that they pointed out to me. One is, and I think this has been well documented, but the discount rate and incremental cost was sort of maintaining and updating those rates, whether it's monthly or quarterly. It sounds like most companies have that have a large lease portfolio have developed processes for that, but there is an ongoing cost with maintaining that information. Another one they mentioned was for operating lease lessors, requirement to monitor your lease portfolio and continually assess collectability. Assuming the lessor is aware of that requirement in the first place, which is a different issue, but they could, there is an incremental cost associated with that. And potentially making adjustments to the lease portfolio as those assessments change. And then in terms of just identifying embedded leases and applying the definition of a lease, I think there maybe is some incremental costs associated with making assessments about decision-making rights. I think there can be a lot of judgment in that process and thinking about what are operational decisions versus decisions that affect the economic benefits derived from the use of the asset, depending on the type of arrangement. I think those can be complex. So even though the definition arguably narrowed from where it was under Topic 840, I think there are some additional judgments that need to be made and some incremental costs associated with that.
Thanks, Ryan. Chris Roberge?
Yes, and thank you for all of this feedback on the cost. I don't know if this is something that we would talk about now or when we get to the end and more broadly, and we talk about the leases project as a whole, costs and what have you. And I do understand, because I've lived this as well for 8 years, that the feedback that the board got at the time, that the costly approach or that the least costly approach that the feedback may have been, and I don't know if that relates to when the project was put on 2005 or the ED in 2013, which is a point that was brought up by Hill of Ray. But when we look back at it and the feedback that we got, and if the assumption is that you know that most, if not all, leases were going to go on book, was the in hindsight, was the least costly approach to retain the operating lease and the finance lease uh, dual classification model, or had the board gone to an all finance lease model, which presumably is like you account for a loan, would that have been less costly outside of the financial reporting outcomes of a straight line cost versus you know, a P&L that depicts interest along with amortization. So perhaps that's something we can discuss at the end.
Thanks, Chris. Derek?
Thanks, Alicia. So this will take us a little bit away from the preparer cost side, but at least from a evaluation perspective or teaching it in classes and things, one of the big differences with regards to variable lease payments is if you used a multiple of 8 times rent, 6 times rent, what have you, that was inherently baking into that calculation variable lease payments, and now the liabilities and that are showing up on the balance sheet, and because the assets then are calculated based on the liabilities, that the assets themselves do not include those variable lease payments. And there's some interesting research by a few faculty at Harvard recently that shows after the adoption of the standard, variable lease payments are actually very persistent. So despite the name variable lease payments, they tend to not vary much with revenue or firms' cost structures. And so looking forward to how to incorporate these variable lease payments, which eventually will become obligations. And for users of financial statements, it becomes a question, to me at least, of who's in a better position to try and estimate these things. As users of financial statements, are you in the best spot to say, here's what we expect variable lease payments to be, or are managers of firms in a better position to do that, to create an estimate that's representationally faithful? And so some, not necessarily a cost per se, but something that at least seems to be potentially challenging, and I think it's mentioned in the discussion materials, is the fact that these liabilities now do not include variable lease payments, which can be meaningful costs for a lot of firms. I believe in that study, the authors show that I think in their sample of large public companies, it tends to be like 20% of firms fixed rent payments. So.
Thanks, Derek. Appreciate that. So go ahead, David. Touchdown.
I mean, yeah, variable lease costs are a problem either way. Our old method in the transition, when I talked about being able to point to why the liability was different, one of the big things was variable lease costs. That was something we could point to. Now we have disclosure. Now we have the number. You know, there's no real magic fix for it. They can be consistent, and but one of the things with variable lease costs is they tend to be more consistent per lease, not overall for a company. So it's easier to understand with growth projections and that type of stuff to incorporate into your analysis. But they're variable. They were variable before and included in a liability that we didn't know would be there. And they're variable now. They're included. And because we add back the rent expense associated with stuff we put on the balance sheet, so we might be slightly different, but we let our variable lease costs and anything short term flows through EBITDA. And so actually from our perspective, we have a bit of a mixed bag, whichever lane you choose, because your leverage can be better and it can be worse if you choose variable lease cost or if you choose on balance sheet lease costs. It just depends on algebra that I never really get my head around. But essentially that's the way we deal with them. But I don't know what we could have better than a specific number related to variable lease costs as far as projection going forward, rather than the last time we were incorporating it sometimes not clearly into our lease liability. And that thought was out there, but it was really helpful for us when we transitioned to know what the difference was. We were able to point to the lever of what the difference was, and it was just about a different way of looking at it versus a hole in the analysis for us in the future.
Thanks, David. Chris, Julia?
Thanks. I just wanted to respond to something that Hillary and I think Chris touched on, and it was about the cost, the incremental cost of what we could have had the board pursued a different approach. And I just think about the receivable and residual approach, where a real estate company would have to derecognize a floor of a building when you enter into a lease. And it just reminds me of the point that Sir David Tweedy said at the beginning of the project. He wanted to fly on a plane that was on somebody's balance sheet. That would have been a fundamental change to the way our companies are evaluated. And my cost answer would have been substantial.
Thank you. Thomas?
Yep, thank you. I just wanted to go back to the point or the question Hilary had on, reasons for the difference with feedback. I think it's hard to pinpoint to an actual cause, but maybe part of the equation is the fact that the leases standard took many, many years to go. There was a lot of outreach going on by the FASB and IASB at the time, so commend the FASB and IASB for the outreach performed. But we went from like a 2010 ED, whereby you had to include variable lease payments, and by the way, even including some renewal options, to a different ED, whereby people said the lease accounting should be different depending on the assets, real estate versus others, right? So we went to a new ED with classification based on the consumption of the economic benefits of the asset to finally to a proposal. And I think that maybe a point Scott was trying to make as well is went to a point where the proposal was we're going to rely mostly on lease classification similar to prior GAAP. The notion of lease term will be the same as in prior GAAP. By the way, you won't have to estimate variable lease payments. And I think that's a proposal that's very enticing, right, from a preparer perspective. And so that may be part of the equation. On the question that Chris had on would we have less cost if we only had like one classification. One thing that comes to mind is the remeasurement reassessment requirements that essentially require you to reassess a lease as if it were a new lease, and part of that is lease classification. So if you were to remove classification, that might be one less cost that you would have, but you would still have other costs such as the discount rate you have to update. So how many costs would you save? I don't know. And feedback from US investors as well was that they wanted to keep a dual classification for US GAAP.
Thanks, Thomas. Nate?
Yeah, I just wanted to provide feedback on that question as well regarding the single classification. I actually got feedback this week from our teams that a single classification would decrease costs. I think what they look at is we have international leases under IFRS, and it's more similar to, I think, what Chris was describing. So we definitely do see some lower costs on one classification model.
Thanks, Nate. Tom?
Thanks. On the observations about the variable lease payments, I think one thing that's important to unpack is to what extent are these trends caused by the broad adoption of the practical expedient. In my space, if somebody's trying to separate lease, non-lease with fixed and variable payments, we send them the technical guidance and it comes back, we're taking the practical expedient. So, to what extent are these really non-lease components that the practical expedient's been elected for would be one observation that I would like to understand with respect to those trends.
Thanks, Tom. Scott?
Yeah, I'm glad a couple other people had jumped in. I wanted to respond to Hillary because it was sort of sitting out there. But one person's perspective, again, when I was there, it was not a perception that people were comparing against an earlier draft. People very much disliked a couple of the earlier drafts, mind you. But I think it was truly an acceptance of these are going on balance sheet. What is our feedback about the cheapest way to do that, as opposed to it's cheaper than the 2013 ED? I don't think anybody would argue with that. But almost to your point, Hillary, and also to Chris's at the same time, right? One of the things that was actually talked about and investigated was Why wouldn't it be cheaper to do the IFRS approach, given we all have PP&E systems? People are basically going to account for finance leases like they do PP&E with straight line depreciation. Most companies have some sort of treasury system. Why wouldn't that be cheaper? That question was actually asked in many rooms. And the feedback was that what the FASB ultimately did would be cheaper, right? That we have processes for preparing the lease footnote. We don't believe that the PP&E systems are necessarily built to deal with now the influx of extra things that we have. We don't necessarily have a detailed treasury system because we may not have a lot of debt. Some companies did, others didn't. So again, I think sort of answering your question, but then also to Chris's, knowing what we know now, people might have different perspectives. But again, I don't think this was framed against this is better than the 2013 ED. This is instead framed in, look, we understand that that train is leaving the station. These are going on balance sheet, and we're going to offer what we think is the cheapest way to get that done. And that included that this would keep us in line more with tax accounting and things of that nature. Those also factored in addition to what they were saying at the time about systems. But that's my perspective of what was going on at the time, Hillary.
Thanks, Scott. Sean?
Yeah, I think it's a good question. I somewhat rooted in the fact that I don't think you got the right information on what the cost would have been in the first place. So if you got what I think is the wrong information on would one have been cheaper? Well, they already thought it was going to be, using the same systems and be low cost. Well, that wasn't right. So, from my perspective, a single classification, I wouldn't say far cheaper, because certainly Richard's point, I still have to get all the operating leases then abstracted and all in a system somewhere. I'm going to spend a fortune to get the standard adopted once you take the concept of, look, getting them on the balance sheet wasn't the option. We're going to put them on the balance sheet. Okay, great. Once I do that, I'm in for a certain level of sunk cost. Now, if you ask me from there, would it be cheaper to have two classifications or one? I think where the root of that situation was people not realizing you're going to need to build a system that doesn't exist today. How hard would it be to build a lease system that had one classification across the entire globe, that one set of standards, versus I'm going to create an operating lease. I'm going to have it do a different set of math. I'm going to have that be different than IFRS. It's going to do FX differently. It's going to have to do remeasurements, reassessments differently. That was extremely complex for the systems to get right. And someone pointed out they still don't do everything right today. That's true. So if I could have done one standard and built to one standard, the systems implementations would have been far less challenging. So, but I think I don't think this was entirely a cost benefit type discussion too, right? I think you probably got a lot of comments on, well, I don't think one classification is the right answer. I think we should have different treatments and the income statement would be wrong. I think and you would have had preparers give that same view. I think I would have been an advocate for whatever's most consistent and cheapest, because I would probably align with the investors here that would say, just give me one approach and I'll adjust. I think companies would have been the same way eventually. I would have said, look, operating leases would have been a better representation of the use of an asset that I'm going to use for 3 years than treating it as a finance lease. But after a few years of comparability, we'd be in a world in which everybody has leases with the way they were, and we would realize that's probably not the best, but it is a consistent approach that allows investors to use our statements. So that being said, though, I would probably just make sure it's an interesting exercise if you're going back to what would you do in the future. I think if you're asking yourself where you are today, I don't think it's a great discussion point, because we have now built systems that do all of these things. So if you told me today, hey, do you have the choice? Would you like to go to the one classification now? I would love to spend a weekend thinking about how great that would be. But then if you told me I'm going to go fix every lease system on the planet now every lease system that US GAAP users use on the planet to shift and change them back. Yeah, I now have processes and systems that do what I need them to do. To go back and shift now would be more painful than back then.
Thanks, Sean. David?
So you don't want to do it again. So I suggest you do it again. No, it's always a struggle with our side of the table on cost. And I think it often gets lost that there is a transition cost, and then there is the future. And that future cost, it never comes into the discussion when I'm asking for change. Like, there could be a single system for leases. You don't need to evaluate finance versus operating. You don't need to audit it. You have everything in one system. It aligns over US GAAP to IFRS, but it always is about, well, we have to get everything in the system. We have to get these tracks built. And I understand that this is very expensive and very costworthy, but I just don't think from a user perspective, we have these discussions that are focused on day two type savings that are both in systems and complexity and audit and reporting of these things. And if it's capable for us to handle this in one gap that is around the world, it seems reasonable we could do it in another gap. And these differences on the lease, operating lease versus a finance lease. I mean, it's a really easy example to say you have a 2-year lease and a 30-year lease, but the reality is when you can walk into the one that's a 13-month or a 13-year lease and a 13-year and 1-month lease, then the argument goes both ways with this comparability. And it's just something I think is an overall good thing to think about, is the day two simplification of some of these things and the cost savings that could potentially come outside of the initial everything to change accounting is expensive. But on the other side, are there any benefits?
Thanks, David. Stephen?
Thanks, Amanda. I want to just kind of maybe put this out there. I know, Sean, you and I are part of these meetings with lease and Hillary, to your question, the question going forward, and I think this came up in one of the meetings when we were looking at leasing, is do we want standards that have precision? And I think that's the question that we really dealt with the right of use asset. And I got to tell you, when we were at these meetings, someone just said, Steve, why don't we just put a number on the balance sheet? And, back of the envelope, we know what these numbers are. And I know, Sean, I was at this meeting and someone said, Steve, I mean, this is not material for my balance sheet. If I just gross up my balance sheet up for the right of use asset, I'm close enough. I mean, remember, it fairly represents what's on the balance sheet. But yet we went down this precision track of looking at every lease. And not only that, though, getting leases internationally around the world translated into English was a whole other cost to do. So I said maybe the point here is, as we think about standards going forward, what are we looking for? I mean, we went down to such a level of precision for the right of use asset. That's what, I mean, Sean, you said it really well. I mean, the time and effort to get that on the balance sheet, the amount of detail that we had to gather. I mean, someone said, Steve, I can just figure it out. I'm close enough to just gross up the balance sheet and liability, and I can get to the same answer. So I don't know, again, maybe thinking about that, maybe I'm being provocative here, but I think that's maybe, Hillary, to your question, those are the options from a preparer perspective, because was it juice worth the squeeze, is what someone would say at the end of the day. Look, I'm all for accountability, but the lift for putting on the balance sheet, and are we thinking going forward, should standards be that precise?
Thanks, Stephen. Any other observations, Shandy?
Yeah, I was just wondering, based on Sean's comments of the idea that it wasn't fully appreciated, the level of systems changes that would be required and the cost of those changes, is there an opportunity for us to involve systems developers, integrators earlier in the process or as we're going along, or somehow bringing that in through the preparer view? I know preparers said, okay, this is going to cost a lot, or this isn't going to cost as much, or what have you, but really understanding the details of what's involved in management information systems of our proposals. Are there any suggestions for how to deal with that so that we have a better idea and it isn't as it's going along and as the systems are being developed after the standard has been finalized?
Sean?
She kept looking at me, so I guess I'm going to answer. I guess my honest viewpoint of that, and I wish we had all the preparers who gave you feedback in the room, because we're a generation later, right? At least in my case. So I I'm skeptical that bringing system providers in would get you the information you wanted. If I just go back to where I did enter leases, standards out there, it wasn't adopted yet, but it was issued, right? We, between the FEI groups I talked to, and then at Walmart, unfortunately, we implemented 4 lease systems. And I led 3 different user groups. So I have a really good understanding of systems. I mean, honestly, my team spent nights after midnight doing FX spreadsheets to get to the system providers because they didn't know how to build the accounting. I mean, we designed a lot of the accounting in the systems. If you brought system providers in the day you put an exposure draft out and said, help us understand the costs, I don't know that there's many system providers out there, or any, that would have known what to tell you. They need preparers to help them. What is it that we want the system to do? And then they can go build a system from that. And then we spend a whole lot of time getting that system built. I will say, in this space, the Big Four can do a good job actually of building some tools that can be an interim solution or a solution for somebody that doesn't want to have connections to, ledgers and those things. So, you do have a provider there that can think through that more, but they're already here. They're already a representative group you have. So I wouldn't call them true system providers in that case. So I do think there's a better way, and I do, we would have hit this later in your agenda when you get to what would you do differently with standard setting, but I'll hit it because we're on the topic, is I do think there's a question or a thought process around what level of depth do you get with preparers. And as I said, reading any one of these drafts certainly would have led me to understanding the level of investment we would have needed to make. I did hear from, I asked the question of the groups, in that Fortune 50 type group of, well, how'd you provide that feedback? What were you thinking? Discussion. And they did cite that, well, the final standard was different than what we provided the feedback on. So to Hillary's point, that was raised. I think there was good pushback from people who I talked to on the staff that said, well, yeah, but would any one of those exposure drafts or every one of those exposure drafts, would you have viewed it as you wouldn't have needed a system? No, I would have read any of those standards and figured I would have needed a system. So, and done significant investment. And if you accept the principle that Scott articulated well, if one of the, principles in which we came, I think the standard came up in the first place, are we going to put leases on the balance sheet or not? Once you say yes to that, I don't know where there was a solution in which it wasn't going to be high cost and a system investment. So I don't know how you ever would have got to that viewpoint. But I look to it as, I think that's a preparer issue, and the FASB does a great job of asking for feedback. If leases is viewed as, well, we found ourselves in a much higher cost model than what you were informed, and it's an anomaly, then I would say that's a preparer feedback problem. And that's something we as preparers need to go figure out. How did we provide the wrong feedback, and let us fix that? If you would say, well, it's not just leases. Let me point to 12 other standards that have had the same problem where the cost benefit analysis was missed. Then I'd say, well, now you got to have a little skepticism on the preparer feedback. And then I think it's a good question to ask is, what would you do differently then to have preparers get more engaged or more involved or get the right preparers, or something different you could do? But I would ask myself, is it a lease standard question or is it standard making question? And I probably wouldn't try to overcorrect your standard making process, because I think you had a pretty good one from what I read. I mean, all the studies, all the research, all the companies you talked to, all the groups, you got the feedback. I think you put out a standard that reflected the feedback. That feedback, ended up being, I think, inaccurate. And as I said, we would hit later in the agenda the things you could do differently in TRG groups and those things. So I think I'll say some of the comments of what I think you could have done in implementation. But the short story of that is, I think the FASB then did a fantastic job of, well, wait a minute, we're in a different world than we thought we'd be in. What should we do? And things like adjusting the date to the practical expedience of, you're not showing the reflective, comparable periods. I think the FASB then reacted extremely well to the change in environment you're in. I look at that as a healthy process. I wouldn't have looked at that as something, that would change. But that's the question I would ask is it least standard or is it all standards? And if it's one standard, I wouldn't overcorrect your process.
Thanks, John. Chad?
Yeah, I just wanted to add, and my day job is not doing system implementation work, but in dealing with lease adoption and helping clients, I was interacting pretty closely with our systems folks, right? And I think the one observation I would make, I think input from people who are relevant to a transition process and the challenges of system implementation, I think it's always good to get those voices at the table. But I was struck by some of our clients saying, this was an installation of a module that sits on its own. And if I'm a system preparer and I'm dealing with a Fortune 50 company versus dealing with a much smaller company and how the data flows in the organization, interfaces with ERPs, even in our own firm, we have custom systems around how we deal with stuff and so on. I was never of the view that one system fit everybody, right? You took a basic module and then a lot of the work was in integrating it into how the company wanted the data to flow and the reports and the information and so on. So I would just observe that if I was sitting there defending a system provider saying, we had a clear vision of what we wanted to build, to me in my head, that feels like that's only part of the story. The story is then how do I integrate that into the larger environment of the company that's adopting it? Is it global? Is it not? How many, are you having to deal with IFRS and US GAAP? Some of those complexities to me, I'm not sure a system provider would be able to predict right at the start. That would be co-developed with their client and so on and so forth. And my experience was that was more challenging than maybe people thought it would have been when they were starting out on the journey together. And again, not my day job, but just an observation from what I saw.
Thanks, Chad. Sue?
Thanks. This discussion about systems is very interesting and very helpful, I think. I guess a couple of things that came to mind when I think about systems providers, and I appreciate your comments, Sean, on how integral the preparer is with the software developer and creating something that works for you. My experience was always that until the standards stopped moving, software providers were a little gun shy about committing to a certain path on how they wanted to develop a particular system or not. So I have a couple of questions. One is, we did a number of updates after we issued the standard in final form, and those updates were they're in your materials, but they were intended to be helpful. They were intended to ease the burden of transition. They were intended to address certain clarifications, et cetera. But that also has an impact on the system providers because the standard keeps moving to a certain degree. And so I wondered if anybody had a perspective on that in terms of, was that a detriment to the software development or not? Was it helpful that we did those clarifications? And then the second question I have is just considering timing overall on how software developers don't like to commit to a certain path until the standard's done moving. I wondered how, and maybe this is for later, how you think we should think about that for purposes of setting effective dates.
I have Blake, and Sean, did you want to directly answer that though? Oh, go ahead.
I can answer the direct question on where the changes made post-adoption helpful or hurtful to systems implementations. Once again, FASB does a great job of reaching out. So Chris Roberge, I'll give him credit, and his team. I would say any changes that people were coming out to, they were reaching out to us, and us being more FEI than Walmart. But what would the impact be? Were you a fan? I would say all of those subsequent revisions were things we were cheering for. So those certainly eased implementation. So we were in lockstep, as I said. We were building spreadsheets for how the firm, software providers could to build the accounting in these systems. So it was, those were things I would say we were hopefully incorporating into what we were doing, as opposed to, oh, this is a change, how do I react? I mean, I would say it was a lot of those were actually because of companies requesting, we would really like this expedient, please. And this might help us actually get live, as opposed to it changing the situation. They were very helpful.
Thank you. And go ahead, Blake.
Yeah, I've done system implementations for I think like 5 or 6 different companies that provide lease accounting software. And this happened all the way from early adoption up till now. And the systems that really do a good job are the ones that are, I think you have 2 approaches to systems. One that's more of a system developer approach that takes the perspective of the accountants versus like accountants that have actually done the work that go and develop a system. And the latter is a much more effective system in my mind. Like it just flows better. It's how accountants want to see things and how finance professionals want to see things. And in my experience, those have just worked better. So I don't know how you could develop a system before people have actually gone through the work of doing an implementation or doing lease accounting. And that's where I think that, I know we're talking about this later on the agenda, so I don't need to speak to it much now, but I think like the whole concept of a field study where you take a limited number of companies and actually tell them like, go and do this implementation and then come back and give us your feedback on what efforts it took, what issues you ran into. I think that would resolve a lot of these issues that kind of had to be revised through ASUs later. And obviously it's kind of like, I don't know, the whole chicken and the egg analogy. It's hard to predict how to best approach it from a system or from like a sequencing approach. But I think there's, I don't know, that's where I would lean, is more of that field study approach, way more than like having system providers come in and do it early, because I think you'll get more benefit that way.
Thanks, Blake. Will?
Yeah, I was also going to answer your question, Sue. And I think like anytime you take something from idea all the way to applied reality, you're going to learn things along the way. And I think to me, I think our feedback, not just from my company, but from our industry, was we really appreciated the changes. We really appreciated the dialogue. And we thought it was a really strong sign of a healthy process that when a standard was issued, one that had been a long time in the making, there was still change and tweaks that were made based on feedback and based on people trying to take it to application. Did that make it harder for the software? Maybe, maybe not. But if we hadn't had those changes, we'd be having a different conversation around this room now, where we'd be saying, hey, we said that we needed these changes and we weren't listened to, and it made it hard. So I don't think we should try and sort of relitigate that too much. I think it was a really healthy sign of the process that there were changes made. I think I agree with Sean. We were cheering them, we were appreciating them, and I think it's inevitable that when you take something as big and comprehensive as this standard and take it all the way into applied reality, you're going to learn things. And yes, that may have resulted in tweaks to the software as you were going along, but I think it resulted in a better standard from our perspective than if we hadn't made them. So, can we get software developers in the room earlier? Maybe, maybe not. I mean, at the end of the day, they need to build what we tell them they need to build based on us having thought through, us having done the work. And I'm probably more in the Sean camp that this is more about, are we getting the right input and the right feedback from preparers on the effort to implement something versus a hole in the process or a deficiency in the process? I think it's a quality of information, not an absence of process, personally.
Thanks, Will. Any other questions or observations or input from people
I
on?
had a quick question.
Fred?
We had a very good discussion. Thanks, everybody, especially concerning both the implementation costs and then the ongoing costs. But listening to Will and I think Nate both said that there's kind of implementation costs may not be gone yet. And I was curious from them, because you've had these iterative need to re-implement. Are we at a steady state yet, or can you see when we will get to a steady state?
So no, for me, implementation costs aren't necessarily gone. I'd say it's largely through choice, because I'm not getting what I thought I was going to get from the first solution. It's not, for me, thankfully, it's not that I don't trust it and I'm getting errors. It's the efficiency, it's the amount of work, and it's the sort of manual effort going on around it that has caused me to say this product didn't deliver what I expected it to do, what was sold to me, and therefore I'm going to move in a different direction. I'm choosing not to see it as related to the standard. I mean, I'm on the same page as Scott. Once there was the high level decision made, there was going to be a cost. I don't now see it as this ongoing cost that I need to tag to a standard and keep talking about, oh, the new lease standard results in these costs. I see it as just the reality I'm living in is, this is what I need to account. This is how I need to account for things. This is what I need to disclose. And how do I make that as strong of a process, as efficient as a process, and as painless as a process as possible? And I looked at the tool that my team was using, and it was not as painless as it should have been. And so we said, we'll move in a different direction. Is it costing me some money? Yes. Am I trying to tie it to the standard and make noise about that? Not particularly. I'm trying to see it as, how do I help my team be more efficient? And how do we continue to like learn and implement and iterate in all of our processes? The fact it's related to the lease standard to me is kind of irrelevant.
Right, but you would consider it part of an ongoing cost of.
I consider
your
it a
function.
cost of operating my function. I don't see it as necessarily an to do with the lease standard personally.
Yeah, I would agree with that, but I think maybe a little bit of nuance that I would put on it is that because it is just a more complex standard that we have now that requires more oversight and attention, you have transition costs anytime you change systems when something is more complex. And so even though in our case our system change wasn't by choice, it was kind of forced upon us, I don't necessarily view that as a cost of kind of tying into the accounting standard, but just generally more complex accounting standards are going to have higher system costs. And so anytime you change your system, you're kind of going through implementation all over again to some extent.
Chris?
Yeah, great. And thank you. I guess I'd ask Michael Chang and Tom as well, because we have had work streams where we've obtained feedback on ongoing costs as it relates to non-publics as well. So I guess like to get your feedback on what Fred had asked from the non-public perspective.
Mike?
I mean, to answer it, I think I'm going to leverage Scott's discussion point. I think if the viewpoint is that we need to get leases on the balance sheet, there's just going to be a cost that's going to be incurred. It's going to be very hard to avoid. I think talking to most private company stakeholders, they don't like the standard. It's very costly. You need external experts to come in and help. They're going to have to buy software. They probably have more than 10 leases. There's a big cost to maintain. So all the things that we discussed. But I think if you were to ask them what they really want and how you could really reduce costs for them, I think they just want cash basis. I don't even think they want 840. I don't think they want the disclosures. I think they just want to book expenses as they're getting paid. And I think that that's a non-starter if you're trying to apply US GAAP. So I find it very difficult to come up with, if there's a practical expedient or there are ways to make the standard easier to apply, I'm all ears. I want to listen to that. But I think we could throw on, another 100 practical expedients. If you have to put the asset and the liability on the books, it's going to be it's not what they want. I think, and I'm speaking in generalities. I get it. I'm sure you're going to talk to some that disagree with me, but I think that's substantially what the viewpoint is in that stakeholder group. So it's going to be a tough exercise. I don't know how you fix that.
Tom?
Yeah, I would respond that the costs of controls over vendor contracts for private companies, especially the smaller ones, is, again, it's an ongoing discussion about the necessary controls and how to mitigate that as best as possible. We're not here yet, but I'm going to say it anyway. I continue to support the low value exception in IFRS being applied to US GAAP to ballast some of the regressiveness in the cost for smaller businesses as one solution to this issue and also promote convergence. I will also point out, and I know we're not here, but since I was asked, the ground is not settled on related party leases yet, and we can talk more about that later.
Thanks, Tom. Any other final comments or observations before lunch? And we will absolutely get into the technical areas as well as additional areas of suggested improvements after lunch as well. But okay, if not, I just thank you all for the conversation this morning. We'll reconvene here at 1. Lunch is if you go out these doors and turn right, there'll be lunch provided down that way, and just really appreciate the enthusiasm this morning and hope to see you back with the same enthusiasm at 1. Thank you. And those remotely, if you want to continue to stay connected and turn off your video, that works fine as well. Thank you. Great. Well, welcome back, everyone. We're happy to kick off our afternoon session, and we have two remaining sections left. The first is really to touch on specific application challenges, and I know that we got into some of those areas this morning, but we wanted to give an opportunity for you all to weigh in on any specific areas of the Leases standard that resulted in application challenges. We provided a summary of what we've heard so far through our post-implementation outreach and whatnot activities as we've gone through on what some of those specific application challenges were. Focusing first on a lessee perspective, and many of them relate to recognition and measurement. But the areas that were identified, and I'm not going to go into a description of each, but really were the identification of a lease, including embedded leases, discount rate, which we've had some conversations about, specific recognition and measurement issues, allocating the consideration between lease and non-lease components, which some of you have touched upon, and then lease modifications, sale and leaseback transactions, including built to suit, that also was raised this morning, and related party leases. Now, some of those areas obviously also apply to lessors, but some additional areas that were identified from a lessor perspective were the interaction of the revenue recognition guidance, in topic 606 in the leases guidance, specific recognition and measurement issues, and the allocation of consideration between lease and non-lease components. In addition to these areas being raised as specific application challenges, there's also a listing of the board actions that were taken place in board or staff actions that were taken that took place throughout that period as well. But with that said, we really want to hear your input on whether these application challenges that we've identified through the process were the application challenges that you identified. Is there anything missing from that list? And then secondly, whether you think there's any of those areas that require further action from the board. And if you do think there are areas that require further action, any suggested solutions or actions that you have, and then relative prioritization, realizing that the board is also going through an agenda consultation process and looking at other areas outside of leasing and looking at allocating its scarce resources. And so an idea in terms of relative priority also would be very helpful on that. So with that, I'd like to open it up if anyone would like to start us off on this area from a lessee perspective, and then I'll ask for comments on a lessor perspective as well. Stephen?
I think one of the biggest, application challenges, I think it's also in there, but it was more the gray matter of trying to understand the right of use asset. And I'm talking about just regular supply contracts, when you outsource contract manufacturing and that manufacturing facility is dedicated to you. And questions that came up in practice, like, hold on, is that manufacturing now under a lease now, because you basically dictate the supply of what's coming out of that contract, of what outsourced. And so we had questions about that and trying to understand that gray matter. Hospitals didn't understand when you drop off X-ray equipment that's still owned by the company making the manufacturing. The hospital was worried. What does that mean now? That since that equipment's in my hospital, now do I own it? Is it now part of this new standard being a right of use asset? All the Xerox machines in your company, is that now something that I need to put on the balance sheet? It's all these practice. It's like there was so many, I would say, so many variables that came up about understanding what is a right of use asset, grossing up the balance sheet for these items that technically not yours, but they're in your facility. And then even have, I don't know, Walmart, I mean, Sean, you could talk about this, like they have inventory in a warehouse. That's all your inventory. Is that now considered a right of use asset? And should that be on the balance sheet? So, I mean, I can tell you how many questions have come up when we were adopting this and trying to understand that. And it was really, really, I would say, difficult to really explain. And I think we got there. I'm not saying that we have to make any changes to it now, but I do believe it was a lot of swirl, I would say. And that's a good word to explain what was going on and trying to explain that, because it actually changed dynamics. And especially for the health industry, hospitals did not want the capital on their balance sheet. So now here they're going to walk away from not getting good equipment in the hospital because of an accounting rule. Does that make any sense? So, so that's, these are some of the negatives of a change in standard just because because we put something on the balance sheet that people didn't want.
Thank you, Stephen. Anyone else want to provide comments? David?
I mean, I think this is just more about like the usual whack-a-mole, something changes and we have to adapt to it and then they move a little bit to the left. But it's generally with like built to suit. And I think coupled with, I don't think the disclosure changed, but I don't know enough. But on leases yet to be commenced, we're having discussions where there's significant investment in dollars involved in a major asset that we know will be leased in 5 years. And it's not tripping the current built to suit guidance and going through, but we are in certain instances taking a different judgment. And it's not that that is a problem for us, but the problem for us comes with the information we have when we want to make a different judgment where we think this is actually their asset and we want to put it on balance sheet. The lease yet to be commenced guidance, I think, is good, but the actual disclosure is not. It's not as easy to separate out these assets as I would have thought based on the disclosure. But that's just one of the practices. And it's not necessarily that we think this is built to suit and we think that that's wrong or right. It's just on both sides of the coin, we like to look at it both ways with some of these issues. And it's not really clear when it's not fulfilling the whatever built to suit guidance under the current. So it's just a future lease that they have out there, but we effectively believe that they do control it. And so there is that type of, I would call, incentive and structuring options that are out there and increasingly out there with lots of sort of non-bank capital coming into these structures.
Thanks, David. Chris?
Thank you. My comments are specific to like ground leases for the rate implicit to the lease. So lessees generally can't use the rate implicit in the lease because the view is that a lessee doesn't have isn't privy to the information, and thus it couldn't be readily determined. So while we understand and think that it's true in many cases, we think there are cases such as in long-term ground leases where the rate implicit in the lease can be readily determined by the lessee. Since a ground lease is tied so intrinsically to the fair value of the land and the land values can be reasonably estimated, REIT financial executives think that the rate intrinsic in the ground lease can be readily determined by the lessee. So we would recommend that FASB revisit the current absolute interpretation of 842, that lessees can't use the rate implicit in the lease and soften the readily determined language, or provide some clarifying examples where it may be reasonable to estimate the lessor's rate implicit in the lease for determining a discount rate.
Thanks, Chris. And that was an area where we spent some conversation years ago on the first leases roundtable on the rate usage as well. So appreciate you bringing that up. In terms of pervasiveness and priority, any comments on that aspect?
In the long-term ground leases typically occur in like corporate business jurisdictions where the city doesn't want to sell the land; they want to keep the land. In terms of pervasiveness, I think it really depends on it's REIT specific, where they own property and where they're the ground lessor or the ground lessee as lessor of the building on the land.
Thank you. Mike?
I think the paper identified, I agree with all the issues or the application challenges. Maybe stuff that's more common in private companies, or at least what I see in my practice, is still a struggle in determining lease term, especially when you just say month-to-month leases. And I don't think that that's a gap issue. I don't think it really was a new issue with 842 either. Same thing with the accounting owner. So the concept of who's the accounting owner of a significant leasehold improvement and that significant impact on when the lease starts or how you actually account for the payments related to that construction. And then I think some of the clients that we had that maybe had longer leases that built on for land leases, that that were operating under 840, not knowing that when you modified it, it could end up being a financing lease afterward. I don't know if any of them require standard setting, but just if you're trying to identify application issues that we encounter, that's what I face.
Thomas?
Yeah, I guess from a lessee perspective, I think topic 842 for the most part works well. So to me, it's more from application on the edges, like maybe some specific leases or when there's interaction with other US GAAP, like topic 805 on business combinations or topic 810 on consolidation. And on that last point, it's more from a sell leaseback perspective and from the seller lessee perspective, but there's guidance in 842 about how to assess whether you have a good sale and separate leaseback. And the guidance is, in my view, clear in terms of repurchase options. It could be on real estate or other equipment. But just to take real estate as an example, if you have a fixed price repurchase option, the guidance in 842 is clear that you have a failed sale. I think what is less clear is people not necessarily thinking about application of other US GAAP, such as topic 810 on consolidation, because that fixed price purchase option essentially absorbs, any increases in fair value of the asset. And from a seller lessee perspective, sometimes there are challenging associated with doing this assessment because they don't necessarily have the information to do it. As many practitioners who work on topic 810 know, application of 810 is very facts and circumstances specific, right? So there's cost and complexity around that. And plus, and I think many entities don't necessarily know that, if you have a fixed price repurchase option, one of the considerations you have to go through is thinking about topic 810.
Go ahead, Chad.
We limited our comments to sort of narrow, quick fix type things rather than wholesale commentary. But one of the things that we thought would be useful to point out is out of the last meeting in the PIR, I think it was 2020, there was an ASU that was proposed. And one of the things that it addressed was language around partial terminations. I think that there is a good deal of confusion amongst clients, both lessees and lessors, about what is a partial termination. And we made note in that proposed ASU, which did not get issued, that there was some fairly helpful language in there that really clarified what is a partial termination and what isn't. And it's funny because when our clients come in and we say, they come in with a partial termination question and they say, well, here's what we think we ought to do, we often point them back to that proposed ASU because we think it gives some really good clarifying language as to what the board was thinking about when they were thinking about the model that applies. And we think it might be helpful to actually have that guidance be something, incorporated into 842 so that the questions, we can point them to the standard as opposed to point them to an ASU that didn't get issued. And we think that would help people better understand the model that's laid out. Because I think as practitioners, I think people understand how it's supposed to work, but I don't know that the reader that's picking it up has a good understanding of how it's supposed to work.
Thank you.
Sorry, I had just one other one. This is again, just a clarifying point. I think we get into some really interesting debates about when you're dealing with a lessor, is a non-lease component, is the payment for non-lease component related even partially to a lease component? Because that drives you in a different direction in terms of how you deal with variable payments and so on and so forth. And I have an idea of how I think it ought to apply, but I'm not sure that there's a lot to point to that helps us really understand when it is partially related and when it isn't. And I think that some clarity around one of the things, and I may be dead wrong in thinking about it this way, but if I'm using the lease asset to deliver an output, my bias would be that feels like that is partially related to the use of the lease asset, whereas others might say, well, is the payment related to the asset? Is the payment varying based upon use of the asset? I think with the guidance is currently written, it's actually difficult to know exactly when it is and when it isn't. And I think it gives me the tendency to say, well, if I can't prove it isn't, then it is. And I would follow 842 in terms of treatment of variable payments. So those two immediately sprung to our mind as places where perhaps a little incremental guidance might be helpful.
Thank you. Nate? Oh, I'm sorry, Jeremy.
Yeah, thanks. So few general observations and then a specific one. So starting general. We've not identified specific topics for which we think there needs to be broad standard setting effort, but there are several known topics in which there's diversity in practice or significant amounts of interpretive guidance. Topics that come to mind: build-to-suit accounting, sale leaseback accounting, accounting for minimum annual guarantee payments. I like the way Thomas put it. I think there's some things around the edges that if the board wanted to take on a targeted improvements project to address certain things, to provide clarity to the standard, to help preparers and users better navigate, understand the standard, reduce diversity in practice, I think there would be an opportunity for something like that. But haven't identified anything that I think needs to be broad in its reach. I think in any event, the dialogue around 842 is going to continue over time. 842 is a big standard. Leasing transactions are common. Things will evolve in the marketplace. Maybe there'll be some point in time for the EITF to jump in and address an issue. But again, nothing broad from my perspective. The one specific thing I wanted to highlight is a lessor issue, and it kind of builds on, I think, something Chad started, is that there's an intersection of the guidance in 842 with ASC 606 on revenue. And I think when companies have both lease and material non-lease components, that guidance can be challenging to digest and navigate. And in my experience, it's not an issue for those that we would historically think of as serial lessors. It's not an issue for the real estate lessors that have operating leases with the CAM non-lease component that gets combined with the lease component. It's not an issue for the financial institutions that have leases with no non-lease services. It's an issue for those that have service or supply arrangements that have embedded leases. And it's an issue for those that don't even think of themselves as lessors or even want to be lessors, but they are. And when you've got those embedded lease contracts, I think the dynamic or the intersection of 842 is just challenging. And Chad, you brought it up, but the guidance around how to evaluate whether variable payments are partially related to the lease component is interesting, and there is no framework, if you will, in 842. And so I think that's a challenging spot. I think there's also conflicts between 842 and 606 around the modification guidance, around the concepts of lease term versus contract term. And I don't know that preparers always know how to resolve those conflicts. Like, do I go with 842? Do I go with 606? The lessor practical expedient, while very helpful for real estate lessors, I think is a challenge to apply for those that don't have those fact patterns. Like, do I qualify? Do I not? And so I'm like building to a point that I don't think that there's anything for the board to do like right this minute, other than, maybe there's, again, some things around the edges, maybe something to monitor, because as technologies evolve and companies' product offerings emerge, this is becoming a place where we're finding more and more of our clients, again, that don't traditionally think of themselves as lessors.
Go ahead, Rich.
Yeah, Jeremy, I appreciate the thoughts. When you mentioned monitoring, one thing that struck me is the lessors don't view themselves as lessors. Is there some sense that maybe we don't have the scope right, that we've pulled more things into lease accounting than we should have in some of these instances? I know the board spent a lot of time on the scope and narrowed it from the prior scope, right? But it sounds like economically, is there really a question running around? Are these really leases? Or are these really just service arrangements?
Yeah, I don't know that I could say definitively that the scope is wrong. I mean, I understand the definition of a lease, and I think it's broadly worked well for most transactions. But I think where companies really do struggle is where there's a small lease component, very large non-lease component, or you're in an embedded lease situation where they view themselves as selling something or providing a service, and they happen to use an asset to do that, and they get wrapped up into the standard. So yeah, maybe the the fix or solution would be to limit the applicability of 842 to those companies and just let them apply 606 because that's what they want to do, just apply 606. And so maybe that wouldn't be a bad outcome in all cases. And so, yeah, hopefully, Rich, that helps with your question.
Chris?
Yes, and I just want to just ask Anna that as well. Are we referring as well in those fact patterns when the pattern of transfer of the non-lease component, that is the service, is at a point in time and not oh and not over time, and therefore they don't get to apply the expedient that we gave to lessors all the way back in 2019. I just want to make sure that I have that right. Like a consumable.
I think it's potentially that, Chris. I also think there's cases where companies struggle as lessors to determine whether they do qualify for the practical expedient. And so I think that is one of the challenges with certain embedded leases. Do I actually qualify? They want to qualify, but they're not sure that they do. I think it is an issue for performance obligations in which the pattern and timing of transfer is over time, but is it truly the same as what you would have with an operating lease? And so that's some of the question that you might have or get in applying the lessor practical expedient. I think also sometimes we see the issue surface with lease components that might be sales type leases, and so then you can't qualify. And what a company would prefer is just to have one big service that gets accounted for over time rather than have my lease components get immediate derecognition and profit associated with those, and then something else be recorded in the income statement over time.
Thank you. Tom?
Thanks. Switching over to the lessee side on the practical expedient, a couple points from our perspective. The allocation rules based on standalone selling price and the inconsistency there with the variable consideration model in step 4 of the revenue standard. I understand there may be concerns about structuring, but it is really difficult to apply, especially with private companies. And so, as I said before lunch, it likely kicks them into the practical expedient to combine, but it also starts to raise questions about whether or not the non-lease component is associated with the lease component. And there's folks that have written about that non-authoritatively, and various views out there about that. And then what do you do if you feel you're not in the practical expedient because it's not associated with the lease component? So I think there's some need for, well, it'd be great to get some simplicity and consistency with the variable consideration model in step 4 of 606. But beyond that, the contours of the practical expedient in 842. I would be remiss if I didn't talk about related party leases. So first, the guidance in 2301 is certainly appreciated and has done a lot to settle practice with private companies for related party leases under common control, to be clear, albeit belatedly. That said, the disclosures are not a state I would call optimal at this point for related party leases under common control. The requirements in 842 do not specify. They point to 850. 850 doesn't talk specifically about leases. Things do not have to be explicitly disclosed in related party leases under common control, specifically the right of use assets, specifically the short-term lease cost related to related party lease under common control, specifically variable lease cost related to related party leases under common control. Further, 850 does have language that would lean you towards aggregating things, which may or may not be appropriate. I do recognize that 850 does have a principles-based statement about sufficient information to inform the user about the nature of the transactions, but that gets applied in a wide variety of ways. So my suggestion would be some more transparent disclosures related to related party leases under common control.
Thanks, Tom. Blake?
Yeah, I want to go back and just provide maybe a little more specific example to what Jeremy was talking about with the lessor practical expedient, because I've seen this come up very commonly in even just like the last year. And I think it's probably an up and coming industry where it's like a AI hardware enabled SaaS model. And we've seen these situations where, to throw in a bigger wrinkle into that even, is we've seen these situations where, because it's a long-term SaaS contract, you may have hardware that actually has a shorter useful life than the SaaS contract itself, which automatically causes it to be a sales type lease, and doesn't qualify for that practical expedient. And so then you have the issue of, you're going to have to replace that hardware at some point during that contract term. And I know there's interpretations out there that says that should be treated as basically a modification, but it's very tricky, and I don't think really accurately represents the economics of the arrangement, because you get this lumpiness. If you treat it as a modification, it's like this lumpiness of a sales type lease that's happening throughout at different points in time throughout the contract, whereas the SaaS, and from the customer's perspective, is really intended to just be, I'm getting this benefit ratably throughout the term of this contract. They don't really necessarily care about which specific asset is being used to provide that SaaS service. Their ultimate goal is just to get the SaaS service. So I think that a little bit further like highlights kind of the challenge with that. And so like, I don't know if my thought was, one way to fix that is expand that lessor practical expedient, where maybe like you take a concept. I think this was discussed in the basis or conclusions in the original standard, where it talked about the concept of distinct versus not distinct relative to lease components. But if you looked at that under the lens of 606, you may get to this point of that being not distinct from the SaaS. But since that concept doesn't exist under 842, then that's, I think, what causes the issue. So maybe you could say something like, if the component would be not distinct if viewed under the 606 framework, and it qualifies, then maybe it qualifies for the lessor practical expedient or something to that effect. I don't know exactly what the fix would be, but those are just some thoughts that I had on that. Another just quick one is lease commencement date from a lessee perspective. The standard says when available for use. I've run into a few situations, and maybe it's isolated to the medical device industry, but situations where a medical device is provided to a customer, kind of the razor blade type model, and there's consumables associated with it. So they deliver the asset to the site, and physically it's there. It requires no modifications or anything like that, but the vendor can basically not sell them consumables until they've learned to actually use the equipment, to be trained and to be certified to use that equipment. And in that case, I've seen diversity where some firms have said, I've had this in 3 different situations, and in one of the situations it was said, okay, you wait till the training is completed, because that's when you can actually use the asset legally. Versus other situations where they said, no, as soon as it's delivered on site, that's when it's available for use, since it requires no modification. So I think just some clarification around like what does available for use actually mean, and what's the intention there? Is it more like when it's available for its intended use, or when it's available for use, or something to that effect?
Great, thanks. Rich?
Yeah, can just maybe to follow up on the server example. You mentioned easier to get into the lessor practical expedient, but when I think of that from the other side too, is it easier to get into the practical expedient because you don't really think it's a lease, or is it because you think the accounting's better? And the reason I ask that's the other side to the contract, right? Is stuck with a lease of those various servers that come along. But the undertones of what you were saying sounded like that doesn't really sound like a lease. It sounds like it's a service arrangement and it's indifferent as to the asset as long as it meets the criteria.
Yeah, exactly. And I think that in discussions with a couple different clients with that situation, I think that's exactly, they don't view themselves as a lessor like what Jeremy was saying. They view themselves as a SaaS provider. And so in their minds, they would just say like the hardware is not distinct. Like the hardware doesn't provide them any benefit on a standalone basis and the SaaS doesn't provide them any benefit on a standalone basis. So like they want to view it as basically a non-distinct component from the SaaS.
And my guess is the lessee, if you had to go talk to them, may have similar questions about why is this server really a lease?
Yeah, I think from the customer's perspective, agreed. Like I think they would just view it as a SaaS contract.
Kristen and then Nate.
Thanks. I'll kind of pick up a little bit on some of this and appreciating I think we're supposed to be in lessee, but we've morphed into the lessor. So I'll try to do a little bit of both, but I think it is interesting. I just make the observation, most other standards, you're only dealing with one side of the transaction. So 606, we're talking about sellers, BizCom, we're talking about buyers, but it's rare that you're talking about both sides of the same transaction in the same gap, which I think has benefits and then some challenges. And I think sort of going along some of that line, these 606 interplay things, the board made a very intentional decision about separation because it was focused on the lessee side and trying to make sure we have a liability on the balance sheet. But therefore, if you had gone through a regular 606 analysis, you might have determined that piece of hardware, that camera, that smaller device would not be separable from the arrangement. And in 606, you pull it together and recognize it over time. But because I didn't get that chance to do it, I was forced to say it was a lease. You end up, and I think that does provide some arbitrage in accounting because certain people could make a choice to transfer title and achieve one outcome. They want over time, ratable revenue is better for them. Or I put it under a lease model and maybe I get a different outcome under that regime. So I think there's some separation, like I'll call it I would fix it sort of through a separation, maybe not so much, but maybe it's a scope and definition of a lease if you thought the other side was equally inconsistent with those outcomes. There's also some repurchase rights challenges. So in 606, if you add a repurchase right into an agreement, well then we said you didn't lose control, you must go treat it as a lease. But what we found is you go treat it as a lease, you go into 606 and you can get a sales type lease, which seems to totally contradict the outcome that we were hoping to get in 606, which was you didn't lose control of this asset because you have the right to reacquire it. So there's some interesting kind of intersection and go back and forth that maybe could, again, on the fringes, and we don't see these transactions significantly, but when they appear, they're usually, it's pretty impactful to those. Just make an observation. There's no material right concept within the leasing standard, but there is in 606. And so a lot of these contracts have both pieces within them. And so you're trying to make sure that the symmetry of both standards is applicable, which one wins, how do we work through some of those things. Maybe on the lessee side, we get a lot of questions, and I don't think there's something to do here, but just an observation, impairment, abandonment, exit cost, all of those things. I think people liked the old 420 model. As soon as I've made the decision to leave the place, record the charge, versus nothing changed in the 360 impairment analysis, but now we have a new asset that is a part of that. And so we do end up spending a fair amount of time answering questions with respect to that model. And then I think we've talked a little bit about build to suit. I think there's probably some improvements in that we could make. And then finally, modifications. Chad mentioned this, the proposed ASU. Our firm felt that was a pretty narrow fix. I think there's probably something to do there. This might not be the perfect fix, but there's probably something that could really help in that context, particularly because usually there's multi-part modification. You're partially terminating one floor, you're adding something else and you're doing something else. And so working through the model, it's really if you did this, or if you did this, or if you did this. But if you're doing 3 of those ifs together, how do we think it should work? So I think there could just be some improvements in a piece of those things to make it simpler.
Thanks, Kristen. Nate?
Yeah, I'm going to try to catch on a couple of things that folks have brought up. So in terms of modifications, I think something that's interesting that we have had a little bit of challenge with is we'll have a lease modification, and as part of that modification, we will change the lessor. So we have multiple legal entities, and sometimes it might be beneficial or just makes sense to change to a different internal legal entity that has the lease. And we use, distinct incremental borrowing rates for each entity. So our bank entity might use a different rate than our broker-dealer entity, for example. And we might have a lease that we transfer between those 2 entities. So that's just created some challenges as to, maybe there's, under the guidance, nothing in the lease terms are really substantially changing, and we wouldn't typically remeasure, but then we have this concept of the rate that would actually change. So that's created some interesting questions for us in modifications. Then another item that someone mentioned earlier on partial terminations, that's created questions for us as well. Things really a lot around unit of account. So something where we're leasing multiple floors, for whatever reason, the initial lease, we decided that it was 1 unit of account. We didn't have separate for the floors, and then we do a partial termination, and then there have been some interpretation questions for those types of partial terminations. And then one last thing that I wanted to mention on, someone mentioned earlier, commencement date or kind of available for use. I've received some questions from some of our finance folks on, we have financial centers, where branches basically where it takes a year to build them out. So we'll rent a shell location and then take a year to build that location out to meet all of our specifications. And the question that's come to me is, well, why do we begin to, expense that on the commencement date when we have the keys, essentially, when if you look at the fixed asset model, I don't begin to depreciate until that asset is ready for use and put into service. So I don't know that it's something necessarily that where standard setting is currently required, but just kind of a few things that have popped up for us that have created some interesting accounting questions.
Thanks, Nate. Tom?
Switch to the lessee side and talk about embedded leases. I said before lunch about the low value lease in IFRS and putting that in US GAAP. Part of that reason for that is whether you call it 5,000 or want to inflation index that to whatever it is today. Isn't really what I'm after. I mean, if you're a big public company, it's not really going to do much, I would imagine. But a smaller company, it would, because you would not have to quantitatively demonstrate that it's immaterial as a non-GAAP measure. And the guidance that was in the basis in the original standard talked about entities could adopt reasonable capitalization policies consistent with PP&E, but it didn't provide the ability to avoid avoiding to have to quantitatively demonstrate that as being immaterial, and also didn't address the fact that property is just on the asset side and the leases are on the asset and the liability side. And so, guidance cropped up in the area that I thought, limited the use of that, and I think would be beneficial. I do hear in reaction to that, well, putting materiality-based judgments into the codification is challenging, et cetera. I'd point to what was done by the board in step 2 of 606 related to material rights that are immaterial in the context of the customer contract as precedent for doing something like that, and how helpful that was. those were my comments on that. I do empathize with the discussion about modifications, particularly the what was termed a partial termination as well, and have seen those issues in practice.
Thanks, Tom. Ryan?
Yeah, maybe just a couple of things. First, on lease identification. I mean, I think there are a lot of challenges around lease identification and thinking about decision-making rights and economic benefits associated with those rights, including substitution rights. But I think I'm not sure what to do about that challenge. That's just something that's continues to be a challenge. From an embedded lease perspective, I think we have seen arrangements where it's not your typical embedded lease, where maybe there's a service being provided and some equipment along with it, but it's actually a supplier is providing the use of equipment or providing equipment that resides on the customer's premises. And you have to think about whether, and that equipment is determined not to be leased to the customer. But then you have to think about, well, is the supplier actually leasing space from the customer on which the equipment resides? Now, I think in a lot of cases that winds up probably being a qualitatively immaterial element, but not always. I think we have seen some arrangements in certain industries where that might be a significant part of the arrangement, or there might be significant value there. And it's been challenging to think about, well, if the contract doesn't specify any consideration for that, if it's a ground lease element, do you just gross up based on the market rates? What if it does specify consideration? Do you use the contractual consideration, or do you have to gross both sides of the transaction up to market? And so I think those have been a challenge and kind of a different flavor of an embedded lease. One other thing on related to sale and leaseback, we have seen some structured transactions where you have a company that intends to acquire some equipment that it will then lease to its customers. There's a manufacturer that builds the equipment. There's a financing entity that will ultimately purchase the equipment and lease it to the reporting entity. And I think in those cases, it's been really challenging to figure out, does the reporting entity have to apply sale and leaseback accounting to that equipment when the manufacturer delivers it to them, with the bank being the legal owner of that equipment? And I think in those situations, we found applying the principal agent guidance in topic 606 to be helpful, but I don't know that 842 really necessarily tells. It's almost like a different type of like build to suit, where you have like a equipment manufacturer versus like a real estate project or something being delivered. And so those have been, we don't see those a lot, but we've seen a few of them and they've been really challenging to navigate.
Thank you. David?
Yeah, I think one of our other narrow issues, it doesn't happen very often, but when it does, it's really, I would describe it as annoying, is when you impair your right of use and in the future you have a disconnect between your cash outflows and your lease expense, and one is not really indicative of the other. And it seems like there's this thing, and it compounds and relates to our cash flow issues with how this shakes out on the statement of cash flows, but it creates what is I've seen described as like a deferred rent type situation. Then in our analysis points to, from the financial statements, that they're just having a deferred rent type situation, but in reality, they just have cash outflows that are not being incorporated in the expense there. I don't have a great solution that wouldn't make everybody roll their eyes using OCI, but I would prefer that this didn't happen.
Thanks, David. Scott?
Can only smile anytime I hear OCI as a solution to anything. I remember a former board member who his reaction would be a little more vociferous to that. I find this discussion interesting because there's a couple things that they're interesting. I think in a lot of the comments that I've heard, I haven't heard people actually come to sort of the question you asked about, Alicia, about priority. I'm hearing a lot of normal, sort of narrow stuff here around the edges, as some have said. And we did just go through a very extensive agenda consultation. And I know that a perspective we shared, it's public, was that we didn't think there's anything here that would rise to a priority. And I'm just, as I'm hearing these sort of smaller items, I know that if you asked people in my firm, we suggest you tackle the items we named as priorities and many other named as priorities before you get to this, and there are scarce resources. So I'll just observe sort of the scope of a lot of what we're talking about here. Maybe in isolation there's things, but where do they fall in terms of priority? I'm almost hearing that answer for itself. Heard a few things. I also found it interesting that, you know, we got like a paragraph worth of lessor that says there haven't really been problems or costs were, and yet more of the comments have been about lessor. So I find that interesting. I wonder if that's a little bit because the lessors didn't really implement new systems, right? I sit here and I think about, from a lessee perspective, we're not starting from a clean slate. If you went back 10 years and you were doing A versus B, honestly, not to hopefully misquote Mr. Jones over there, but he made this comment at the 9-3 meeting, which coincidentally I thought teed up this meeting very well. But it's like, we're not looking at this. It's a sort of the cost benefit equation is now to change from where we are, not from what might we have done 10 years ago. And I'm wondering if that's part of the reason we're not hearing a lot of stuff around lessees, because most people did end up putting in systems. And really, there's not an awful lot of changes you could make to the core lessee model that wouldn't affect sort of the systems and processes and other things that have been put into place. So, occurred to that. One reaction I would encourage, that there were a few comments that to me harkened back to the 2013 exposure draft had this notion of assets incidental to a service. When I was hearing Blake talk, I was thinking, boy, that was bringing up some painful memories, right? And the idea was that, you know, this idea at least was similar to that concept. And there were reasons that got abandoned. So if we start trying to think about, however you characterize it, whether it's a distinct concept or sort of when it's only a minor asset related to a service, I just sort of remind that we actually did try this. We exposed it and it didn't really test very well. So we either have lessons to learn from that if we were to try and to reintroduce it, or potentially that might remind us why we collectively as the accounting world didn't go down that route. Couple other things that other people mentioned that I'd taken notes on. I think lease commencement is an issue. I don't have a solution for what I would change. I mean, the lease commencement date guidance has really been the same since 1976. I think the stress, where I think Mike raised and others, is that now what you see is a desire to delay, right? Nobody wants double occupancy expense, right? That seems to be a thing we put on, right? So you get a lot of pressure on this leasehold improvements concept, but I actually think practice has dealt with that pretty well. Like, I think we could figure out which it is. But again, what you're pressing against oftentimes is a desire to have things be lessor owned, because that pushes out your commencement date, when that really isn't the way you would have ever thought about it in the past. So it's sort of trying to change people's mindset. So again, I think I know why lease commencement issues come up a lot. It's frankly for wanting A, but you can't get A. I don't think it's necessarily a fault with the guidance. On build to suit, I would agree with others that I think, you know, that was one of the last things that got developed in the standard. And when you look at some of the particular factors, we've had interesting fact patterns come up now where a literal reading of some of those factors, A through E in 842, 40, 55.5, you know, you can tell that it wasn't contemplated when it was being written, this particular thing. Like, just one example is, you know, paragraph E talks about, you know, the lessee is leasing the land and doesn't sublease to the lessor. Well, what we're seeing frequently now is that lessor that's leasing to the lessee, it is actually the lessor. It's the same party. And the wording of that paragraph doesn't really, you can't really structure it well. We've sort of dealt with it in practice amongst firms. I think we're in a generally reasonable spot. But between that and a couple others we've seen, from a targeted improvements perspective, again, noting my comments on priority, I think we could either add to, re-clarify, maybe it's example, I don't know what it is, but I think there's ways you could solve some of the extensions that weren't thought of when the 55.5 guidance was drafted.
Thanks, Scott. Sean?
Yeah, a few thoughts. First, I would just like to say modifications and build to suit keep coming up, and they were in the write-up as where there's certainly discussion on those out there. I do commonly refer to as two of the greatest GAAP rewrites I've seen in the history of GAAP. So I definitely would be hesitant, you know, to touch, or I guess at least, you know, change what's in modifications or build to suit where I would lose having those as two of the greatest gap rewrites I've ever seen. And then also I think anything, comes back to priority, but at this point where we are, anything that changes process, changes systems, or can takes, takes me away from IFRS alignment, you'd find us any one of those three as preparers being highly resistant to wanting to change. So now if it doesn't trigger those three, then we're all ears. And I think some of the tweaks that have been discussed here would do that. So I know Tom had mentioned the 5,000, the big public companies may not be a fan, Well, I think I qualify as big public company. And I would say, hey, the 5,000 thing, yeah, we'd love that too. Because we use materiality, thankfully, in our favor. And I can use materiality at a company like Walmart far more than a lot of companies can. But putting in the 5,000 exclusion seems like an easy tweak. But what it does for a company like us is it takes that floor of things we've said, hey, we're just not going to do. And it makes that, it raises that floor where I would say, oh, I'm not complying. I'm actually okay for that segment. How I quantify that gets interesting, but at least I know I've already used my materiality thresholds, and I can then at least point to the auditors of the world to say, yes, but what I've excluded somehow became less now, right? So we certainly would be a fan of something like that. Embedded leases, I think, is one we struggle with even, and I am thankful for the practical expedient with combining or not combining the lease and non-lease. And thankfully for our size, we're able to use materiality to make embedded leases more manageable. And by doing that, I can take the large asset categories that we'll lease, obviously things like stores, right? Out there that allow us to then say, well, let me just combine. And yeah, that puts a whole lot of stuff on my balance sheet. And hopefully the Moody's of the world can figure out what we're doing there and be able to look at that. And they probably used 8 times rent anyway, so it's not really throwing them off. But from our perspective, I can combine there and then not do the separation of lease and non-lease because for us, there's a practical implication then of the alternative. If I don't combine the lease and non-lease, which I then did for anything that was what I'll call small asset leases, I can then, for us, we just said, I'm just not going to do lease accounting on things like PCs and printers at a company of our size, because I can just exclude the whole class of asset. I don't combine the lease and non-lease, so now the asset value is smaller, and then I can just exclude that asset from lease accounting altogether, and I don't do printers at a company of our size, because I can do things like buildings, and no one cares about the printers for our financial statement users. That allows us to put a pretty manageable world of the lease standard. Where I empathize with companies that don't have the ability to bifurcate into those two separate worlds and live with that. And I would say we run the continual struggle of all those excluded class of assets we put. I'll take, are my auditors in this room? They are, right? All the firms are here. The solar industry is a good example, though. Where, well, we're putting a whole lot more solar panels on roofs now, right? Well, that's an excluded class of assets for me, so I wouldn't use it. Now we can get into whether solar panels qualify as a lease or not, but let's just go with this one. Well, you see those start to go a lot more places. Then it just puts pressure then on us to say, well, wait, do I have to then start bifurcating the lease and non-lease because I didn't elect those? Or a large warehouse that's now run by a third party. Am I effectively leasing that warehouse, or is the third party providing the service? If I look at that third party warehouse and say, we could be talking hundreds of millions of dollars to billions in assets and services here. If I have now separated the lease and non-lease on those, or didn't combine, and I've got this huge service contract, but I have these assets that are significant in those, the world in which I would then have to say, well, wait, you didn't combine, so are you going to then, you get a bill in from your provider, and every bill I get in, I then have to go back to that contract and say, wait, what was the split of the lease and non-lease, and make a payment for that contract to be able to split those lease and non-lease components. I don't know how I run accounts payable. I don't know how I pay those bills, because I don't have someone in accounts payable who gets the bill, then comes back, goes to the lease system, and then looks up that lease, looks up the split of the lease, non-lease, and properly allocates that. Now, maybe I can try and make some conventions, but these buildings are very different across sizes and the contracts are different lengths, terms, and investments. It would be hard for us to just justify hey, I'm just going to use some rate that I'll apply that somehow accounts payable would know about. So that's just a world where for embedded leases, that is certainly a challenging space within the standard. Back to prioritization, and I think Scott put it very well. Would you go back and prioritize this versus other things you're working on? Thankfully for us, we have a model that works. I have my technical accounting group was in here. They'd probably be arguing with me because they still deal with these. But I keep coming back to them going, materiality is our friend, and it certainly is. But if we ever grow those excluded class of assets large enough, that becomes a challenge, then we'll join the world where many others are, where embedded leases are what they do. There are 3PL companies, third-party logistics companies out there that do that for a living, and that is their world. They have all of those companies. I think that is a very problematic piece of the standard because of the practical ways in which you need to now account for it, not the theoretical. I think theoretical, I can decide those easy. I can decide if it's a lease or not. I can classify it. I can get it in the accounting. But for me, it's how do I then practically do the accounting is where that really runs into a problem as a preparer in that part of the standard. So I don't have it on a priority and move for something else because I think I worry. We've thrown out a lot of ways in which we've talked about it, and I've looked at every one of those and said, I just don't see the FASB adopting that. I don't think you can really say, well, let's, hey, if it's a mixed contract, then don't worry about it. It won't be lease accounting. Let's just use 606. Well, that doesn't work from the lessee side. So from the lessee accounting, I don't know how you would, as a FASB, be comfortable saying, well, go ahead and treat it as a lease or don't treat it as a lease, and we just won't try and split. Because you're going to get into the practical then of, well, I'm either going to take billion-dollar third-party managed large contracts and just call them leases and put them on a balance sheet. And I think the investors here would say, well, that's really not helpful for us as users of the financial statements. Or I exclude them altogether, and now you've got significant multi-hundred-million-dollar assets that I just ignore lease accounting. That doesn't feel great either. So I'm back to it's a very painful, I think, piece of gap. But I think the FASB probably did pretty well to say, well, I don't think I can ignore or not ignore. So if I'm going to do something, well, here's what you end up. You're going to have to go through and decide what you do and elect to combine or don't elect to combine. That's an option you have as a lessee. And then you're going to probably have to do your best there. So I don't have a practical answer on really that fits my three screens: process, systems, and IFRS divergence, where I would be comfortable making those changes. The last one I have, which I do think is passing my three screens, is comparing variable lease accounting to owned asset accounting. And I'm putting myself in the frame of mind of I'm going to somebody who's in our business. So outside the accounting controllership type, public accounting viewpoint that I think sits in this room. But if I'm just going into the business people who run stores or run buildings or run banks, and I'm saying, hey, if you own an asset, this is just a store we own, and you're going to go do, $1 million, $800,000 parking lot, resurface and finish, or you're going to go replace the roof and do roof replacement. That's a capital asset. I've extended the life of that asset. It's useful life. I can capitalize that, throw that on the books, and I can depreciate it over the life of that asset. If I have a leased location, though, and obviously I have regional managers, let's say, who have both owned and leased stores, and store managers who own those P&Ls, and on the one they say, okay, great, that's over time, I'm good. Wait a minute, that other one, why did I just take an $800,000 hit to the P&L this month? Oh, I'm sorry, that's a leased location. And because it's a leased location, that rent wasn't known at the time of commencement. Therefore, that's a variable lease payment. And since it's a $800,000 improvement to the store, parking lot or roof, it's a variable payment to the lessor. And because it's the lessor, that's not a third-party contractor that we owned, I have to expense that. You lose them. So I think there's some differences between now, if I could remeasure the lease, which is a convention that's in the standard, that's in my system. So I think there's a question, an area here I'll agree. I'll go to Scott and say, is it on the priority of needs for you? But I do feel like there's a space there where you're not changing the accounting processes or systems, but it has a potential for when could I use my remeasurement trigger to allow me to remeasure a lease as opposed to treating something as variable lease expense. So I know IFRS has some conventions around if contractual payments change, you can remeasure the lease there. So I feel like there's a path there, but that's at least one that I would float. That's it for me. Thanks.
Thanks, Sean. Tom?
We do view the issues surrounding identifying leases for smaller private companies as a priority for the board, consistent with the PCC June 26th agenda memo, which I cited earlier as being reflective and also written in PG compared to other sentiments that we hear about this standard with smaller private companies. With that said, I should have mentioned earlier with respect to those companies, another cost that users are incurring. I was focused on the cost that the preparers themselves were incurring earlier, and that's the timeliness of statements. These issues are causing statements to be even further delayed for private companies, and they're only obviously typically annual as well. So I think given all that, we view this issue as priority for the board.
Thanks, Tom. Chris?
So I wanted to talk about the incremental borrowing rate and the change in the definition under topic 842, that you have to use the collateralized basis when determining the incremental borrowing rate. And the reason why this has been challenging is that most REITs fund themselves with more so with unsecured financings than secured borrowings. And when they acquire properties along with land purchases, they're completed without specific secured loans and instead are made using either equity or unsecured bonds. And then the second thing touches a little bit on what I was talking about earlier with like the longer term ground leases. So ones that are longer than 30 years, there isn't a market equivalent on the secured side for our members to use. So they've gone through and come up with ways to estimate and make comparisons. But it does take time and it can be costly to apply. So the recommendation would be, I guess, if you were to go down the targeted improvement path, would be to remove the collateralized part of the definition.
Okay. Any other thoughts or observations, questions? Okay, well, we covered a lot of ground on suggested improvements and really appreciate that. And so we'll move into the improvements to the standard setting process. And to start us off on that, Ashley.
Right. Thanks, Alicia. So the purpose of this topic is to obtain feedback on potential improvements to the standard setting process. I know we touched on this a bit briefly this morning, but we're curious to hear the rest of your insights. So to facilitate this discussion, in Appendix A of the materials, we provided a summarized history of the Leases project. This includes the case for change that was derived from criticism that the previous accounting model for lessees failed to meet the needs of financial statement users. In particular, both the SEC's 2005 report to Congress on off-balance sheet arrangements and a number of academic studies recommended that changes be made to the existing leases guidance to provide greater transparency and to better address the needs of users. In response to these concerns, in 2006, the FASB and IASB initiated a joint project to develop a converged leases standard. 3 due process documents, including a discussion paper and 2 exposure drafts, preceded the final issuance of Topic 842 in 2016. As we already discussed during Topic 2, during the development of the leases standard, stakeholders provided feedback that lessees would be able to apply the requirements of the standard using similar systems and processes to what they had in existing guidance. However, there was a significant gap between what was initially communicated to the board and what was actually experienced by lessees. This led to the board issuing an additional transition approach in 2018 and deferring the effective date for non-public entities twice. Based on events that occurred during the development and implementation of the Leases standard and stakeholder feedback, we've identified 5 areas that could potentially be opportunities for improvement to the standard setting process. These include convergence, systems and process assumptions, consideration of legacy guidance, transition guidance, and setting and deferring the effective date. And details on each of those areas are included in the materials. I'll now turn it over to Alicia to facilitate the discussion on questions 8 through 11.
Great. Thanks, Ashley. Really appreciate it. So wanted to open this up really on the overall effectiveness. And then if you've got specific feedback on the transition methods, including the practical expedience, the factors the board should consider related to effective dates, and then if you have any other suggestions for improvement to the standard setting process, just want to mention that we won't get into the PIR process itself. That's the next question. So if you could focus the aspects up through the issuance of 2016 to start. Go ahead, Chris.
So I didn't realize we were jumping off of lessor accounting. So I did have something that I wanted to raise.
Oh, great.
If that's okay.
Sure, absolutely.
And it's specific to establishing reserves for the rent receivable. While it may have flown under the radar, establishing the reserves was a key change for lessors under topic 842 that wasn't anticipated. Reserving the accrued rent balances and reverting to a cash basis, the binary credit test of it not being probable that a company would collect substantially all of the payments doesn't necessarily reflect how credit is being assessed. So prior to topic 842, one methodology that some of our members use was a rating system. So you'd have like a 25% reserve, a 50% reserve, or 100% reserve, depending on certain defined characteristics and risk characteristics. This or another way may be more representative to the reader for the risk of collection and generally how credit risk may devolve over time. So like, I think what's been challenging is, especially with COVID, that was pretty much the test case for how this would work. So even though some of our members knew they were going to get some of the rent payments, if they didn't meet the high hurdle, they had to write it off and go to a cash basis, which took a lot of time and effort then to try to educate the investors and analysts that follow our industry about, well, wait, where did the rent go? And why is it on a cash basis now? And then flipping the switch and going back to was an education process as well.
Thank you. And I appreciate you raising that. Is there anybody else from a lessor perspective before we go into the standard setting process? Chris?
Well, yeah, I just want to get my great, and thanks for that, Chris. I just want to ask you on that. Did the discussion that occurred at the July 2019 board meeting, whereby the staff gave 2 ways that perhaps you could establish a reserve. Did that help, or is it just the fact that that once it was tripped and that you conclude that it's not probable, the fact that you have to go to cash basis at that point, i.e. sort of like a non-accrual type, does that continue to be a problem for your stakeholders?
I think in the current state of the economy, we're okay. But obviously, like with the pandemic, that was something that just, I think, opened everybody's eyes about what the change was that they didn't necessarily understand beforehand.
Any other questions or the clarification is helpful? Any other questions, comments? Okay. So we'll move back into the standard setting process aspects and would welcome any comments about overall effectiveness of the standard setting process, transition effective dates, and then other suggestions for improvement, really focusing on up through the issuance of 2016. So anyone want to start us off? Kristen?
Thanks. Maybe just a couple comments and then, so convergence, I think it is, obviously it's helpful. It reduces the cost. And so I think when it's available, it very much helps. But I'd also observe that, again, back to my chapter in a book, it's only one chapter. And as soon as you have a transaction that's sort of intersecting outside leases or outside revenue to FIG or to someplace else, even if you're the same, it's not the same. So sometimes just, I think, considering that and how that would go about the board's decisions about things. I did want to make some comments about transition. Obviously, it was lots and lots of pages in the book. And if I opened my book, it would fall open to that section. So that I spent a lot of time in that section. And I think the board was intending to do helpful things to help people in the transition. And of course, heard some feedback about their original proposal and moved from that. But I think what we found is it was really challenging because it was so specific that thinking of every possible scenario of what somebody could have been doing to what they would be doing, because it was so specific, there wasn't a guiding principle to it. And so we struggled, I think, and I think generally people were pretty accepting of reasoned judgments and we moved ourselves past that. But just maybe an observation for the board in terms of in the attempts to make it better or more perfect, sometimes it gets lost. And then there is a challenge with this particular transition, which is the grandfathering. So which was great to grandfather a number of things, but lease contracts are quite long. And so there's a lot of these contracts that the old 840 accounting is still here today. And quite frankly, we probably could even find an 018 lease definition that was grandfathered, that got grandfathered again. And so I just observe, and I didn't know if this was right in cost or if it's right here, but maintaining a knowledge base of that was an acceptable conclusion. If land wasn't greater than 25% of the combined thing, you could keep it combined. If you didn't transfer title of that real estate property, it was never going to be a sales type lease. Some of these things that were commonplace under 840, but are, we have a generation of others and other accountants that are going to come. And so those things are hard to keep. And we've also seen in cases where somebody's transition memo in their audit file didn't get retained. And then perhaps engagement team switches again. And how do we get back to what was that conclusion? So I know the intention was to make it easier and helpful, but it's always helpful in the short term, but in the long term, considering how that goes forward. So just making some of those observations.
Thank you. Derek?
I'll just tag on to what Christian said a little bit about convergence. So I think particularly for the leases standard, obviously there was a big push for convergence at the beginning, and I think it goes back to the SEC's report. However, I think what Kristen mentioned, especially when you're considering multiple jurisdictions, a lot of times the concept of transactions can differ across jurisdictions because of the various institutions that exist in those jurisdictions. And so I think something that's apparent if you look at the various exposure drafts for this standard and what was ultimately issued in the basis for conclusions, there was a lot of differing feedback from constituents that were subject to IFRS as opposed to US GAAP. And it seemed some of that was around the different institutions that were set up in those countries, where in certain countries, the concept of these leases that are more operating versus finance were not necessarily as strong as they may have been in the US, where you have institutions like bankruptcy court or tax law that tend to distinguish between leases as well. And so, although I think convergence obviously has many benefits, both for preparers and investors, as has been talked about multiple times in this discussion, there's also some potential cost to going to convergence is that you'll lose some of this nuance that exists in different countries. And there's a variety of academic research that speaks to this and shows that indeed users of financial statements can interpret transactions differently, although accounted for the same because of different institutional factors. And so obviously it's a challenge to weigh the costs of potentially requiring different standards against some of the benefits that exist by having nuances that exist in different jurisdictions, but potentially something to be mindful going forward as as standard setting progresses, and I assume convergence will always continue to be a topic when accounting standards are pursued.
Thanks, Derek. Jeremy?
Yeah, I'll just continue the discussion on transition. So Kristen mentioned the transition guidance was long. It was 9 pages. And I went back and looked at our interpretive guidance on transition. It was almost 100 pages. So never would have thought we would have needed so much interpretation on transition, but we had it. And then just to add, when companies were adopting 842, they were really thinking about 3 models. They were coming off of ASC 840. They had to think about 842 for new lease arrangements, and then they had to think about the 840 transition model for transition leases. And then if you focus more specifically on the transition model, because of all of the options that companies had, it was an element of choose your own adventure with respect to transition. And I don't know how systems dealt with that. I'm sure that was a challenge, but just so much in play. And then as Kristen also mentioned, we're like still living with the transition model. There were certainly things that were helpful in transition with the practical expedience, and I can't imagine the cost that we'd be talking about today if everyone had to reclassify their leases at adoption. So that was a big time savings. Sitting here today, could I say that I would have come up with something better in 2016? I don't think I could say that, but sitting here today, would I do something like we did for 842 again for another major standard? No, I would do something different. And so to me, that's the point is I think we learned a lesson about what happened with 842 and transition that hopefully we don't like revisit prospectively.
Thanks. Any other observations? Go ahead, Scott.
Thoughts that I had. Thanks. Just looking at a few of the points that were raised in here that I had jotted down. I mean, I guess starting with Jeremy's point, it's interesting. What would the options be for transition, right? With leases, you could argue perspective, but then you had leases that were, 20 plus years length, and then those are the majority of what would go on the balance sheet. So we could have been waiting 20 years before the majority of the lease dollars made their way to the balance sheet. So I think that wasn't going to be much of an option. In full retro, I'm just trying to picture the reactions that people would have had if you just had to do a full retro. So I think did it need to be what, triple J paragraphs? That we could debate, but some of those got added over time to the points people raised. But I do think it was the appropriate perspective to try to come up with some sort of modified retro way that didn't allow leases to, particularly the big ones that are usually longer, to stay off the balance sheet for 20 years. Then kind of why bother? We'd all be retired. So I guess we didn't need to bother with it. But yeah, so I just think about transition. I don't know if there's a perfect answer. We can always learn from the past, but I think a modified role and then the board's actions to try and make it even easier as we went along. Yes, it added GG and JJ and LL paragraphs to it, but each of those additions to the points Will made earlier and stuff, I think were based on requests and didn't make it harder, even though it made it longer. Just a couple other thoughts on convergence. I think that should always be a goal, but what I remember is that when convergence got lost, if the standard had been converged, that would have meant one of the boards had fundamentally just not listened to their stakeholders. They were getting diametrically opposed guidance. Okay. There was no way, like they were damned if they did and damned if they didn't. Convergence was gone. And then, but they listened to their stakeholders, which were giving them very different feedback, or they would have been accused of not listening to their stakeholders. So I don't know what more could have been done. I will make the encouragement at this point. Let's do whatever we can to not make it worse, right? The things that are converged, there's a lot of areas when we throw out ideas of potential things to tweak here, tweak there. I would try not to do that. I would just say the cost benefit hurdle becomes even higher if it both, for example, changes systems and processes and further deconverges, making people do 2 things. Just a couple other thoughts. There's a notion in here of more field testing. I think the struggle with that is there was field testing done after the 2013 ED, but I will call it limited field testing. I don't think the FASB would be very successful, right? People didn't learn how extensive this was going to be till they jumped into the deep end. And I'm not sure what companies are going to be willing to jump into the deep end, incur that cost just to help the FASB with its process. I think that's tough to justify to your stakeholders. So I think that's going to be a difficult thing that's talked about here to actually ever enact. There's one other notion in here that, I would not. This came up at the 9-3 meeting, but I don't think the FASB should try to estimate how much people are not applying current GAAP. I think I would continue to say that it was the right baseline to assume that people were applying GAAP materially correctly. Because again, the question to me is by how much, right? People varied if they weren't, for example, if their lease footnote was not at a level of precision in the past. The question would be by how much? How much do you estimate that to? And I just don't think that's really the FASB's job to have to take on that cost of estimating, how much, especially since that might require you to factor in 10 different levels of how far are people off from applying the standard. And the last piece I had here was there's a notion about the TRG. One thing I'll leave a thought on is it's careful not to compare one standard to another. The revenue standard was very technical in its implementation. So the TRG, oftentimes your implementation was writing a better memo that covered the aspects of the standard. I've had discussions with a few preparers and, maybe some others have some thoughts on this one, but the Leases standard was much more operational than technical. And it took the TRG sometimes 2-3 meetings, often months in between, to resolve some of these issues. And if that necessitated a system impact, a system change, then we're talking about a significant delay in time from the TRG to resolve it. So sometimes we needed things quicker than was really inherent to the TRG process, as well as it worked for revenue. So I just caution it's not one size fits all.
Thanks, Scott. Tom?
Thanks. So I'll provide a little different perspective on transition from private company and not-for-profits. There were pretty important things that were not specified in the transition guidance that, yes, there was non-authoritative guidance out there, but it's in multi-hundred-page manuals. And I'll point specifically to minimum rental payment composition policies and elections or decisions about the incremental borrowing rate and whether it should be for the remaining term or the term at the beginning of the lease, as being two specific things that were not specified in the transition guidance that were important for the transition adjustment. Also, since we're talking about process, I would be remiss if I didn't say this. Maintenance update 2023-07 removed all of the transition guidance from 842 before the effective date for fiscal year-end private companies and not-for-profits. Now that has subsequently been restored, but whatever, I don't know what how the maintenance updates work and what the due process is for those things, but that was not optimal. Second on this, the relief, the staff position on COVID modifications was helpful, but it was written assuming you adopted 842. At that time, almost most not-for-profits and almost most private companies were on 840. Now you can analogize from it, and we did, but it would be nice if that perspective had been considered as well.
Chris?
I just wanted to touch on the TRG. Even though there wasn't a TRG for leases, I know I felt like if we ever had a implementation question or, something about common area maintenance or COVID, the staff was extremely available and helpful to listen to our concerns and work with us to try to figure out what a good solution would be. So I think from that standpoint, like the FASB did a great job.
Thanks, Chris. Rich?
Yeah, it's back to the TRG topic, right? We did surround this standard with 2 TRGs, right? One on RevRec, one on Cecil. And it's really more for the preparers and the investors because I pulled some of the firm lease guidance and they range from 350 pages to 1,200 pages. There's a lot more in there than is in our standard. And one of the benefits of a TRG is that it gives all stakeholders a role in addressing those things. And I recognize I don't fault by any means the firm publications because they fill a void, either in explaining something in plain English or answering questions that people have that aren't necessarily clear in the standard. But I do have a question for the preparers. Do you feel if we don't have a TRG on a major standard that you don't have a voice in how some of those things get resolved? I'm just curious.
Sean, do you want to weigh in on that?
Well, I knew he was going to ask the question, so I had my card up already. So yes. So directly on that one, it is a great question. I don't think there's a one size fits all answer to that. I actually think for RevRec and Cecil, I think those made great sense. I think the RevRec was a principles based. I think it had us looking at all the types of transaction types we have and thinking that through. But I wasn't building a system tomorrow. I wasn't changing journal entries tomorrow type thing. So I felt like the TRG is going to be a slower process than what I think we had and needed in leases. So I think it works well where in those situations. The leases world, and I guess it's a little bit because of where we started, right? Where I think the timeline and transition and everything was based off the feedback you got of how long it would take. So, but it put us in, a place where we were moving rapidly and well behind and trying not to ask for, give me 4 more years, right? So in that environment, I would say speed was the most important. And I guess I certainly wouldn't want people to backtrack, and change their decisions because I got to go reprogram. But speed and quality would be huge. I think the TRG is fantastic for quality and it's fantastic for consistent and feedback and inclusion. But I think in the leases space, the speed would have been my highest priority. So I wouldn't have been able to do it. I think the way the staff reacted, and I thought it was a good call out with the staff being engaged. But through forums like, we're in FBI, we had the leases working group and all the firms called into that. And the FASB staff joined every meeting. And we would start out with what's going on. The firms did a great job also of getting at least the big 4 to get together. And they had periodic meetings of what's going on, what questions are they addressing. And they would bring those to that group of the Fortune 50-ish to say, hey, here's what we're looking at. But then for us, we called the meetings. So I was able to call a meeting as soon as I needed a meeting. So when I had enough topics where I'm like, look, I don't know how to go program a system tomorrow. I'm able to call a meeting. I'm able to get the big 4 in. I'm able to get the staff in. And I'm able to say, here's my topic. Here's how I think I would address it. And 4 firms were able to say, yeah, that seems logical to me. And the FASB staff was able to say, I'm not the FASB, but I can't see a flaw in your thought process. Okay, well, as a preparer, I just had 4 firms and a FASB staff say they wouldn't object, or they can't object, but they don't have consternation with what I just described. That's gap for me, as far as tomorrow, I'm going to get off that call and I'm going to talk to 3 different leases working groups, and I'm going to disseminate that to 3 different systems. And shortly thereafter, it's going to make it into 4 firm guides. But I couldn't even wait for the 4 firm guides to be updated, or whichever one's your auditor, if you wanted to pick it, because I'm literally I'm trying to program a system that is not knowing what to build tomorrow. And I'm trying to get that pace to them. So a lack of a TRG, but a highly invested firms, thank you, and staff, thank you, made that doable for us. And to bring it down to perspective, we went live with one of our lease systems in year-end close of the month of adoption. That's just, if that doesn't resonate for you, then you probably haven't been in my role in a while, but we don't adopt systems in year-end close at all. We did that with this one because that's when we finally got there, and it was well, what do we do, a manual or not? But we ended up pulling it off. But that's the timeline I was on. So if anywhere in there we had slowed something down, then I'm probably in some manual that was ugly type alternative. So instead, we were able to pull that off. And I look at that as one of the, you could question, well, should there have been different ways you didn't end up in that position? But I did look at that as that's an incredible success by everybody to work together to answer questions, get those updated, get the firm guides out there. And yeah, the volume of those guides, thankfully there's search functions, so I can go find what I need. But it's, I did read a couple of them from start to finish. I mean, those are helpful to have. But really, it was that interim before the guides even get updated. That speed of pace of answers. There were so many questions that we were diving through that were just nuances nobody would have thought of, and I wouldn't have asked you or wanted you to put that in the standard itself. So I think getting those things covered was key for us. While I got the mic, there were a few other things I would hit. Convergence. Yeah, I'll 100% support wherever you can converge as a multinational company that has to do, financial statements in a lot of places. That convergence is certainly key for us. And I think Scott put it well that, okay, I would have loved, in hindsight, probably would have been easier for us certainly to have one lease type, but I think he was spot on to say you had a strong audience in the United States, at least, that was not fans of that for US GAAP, right? I get that. So, but I still think the board did a great job then in many parts of the standard to say, well, okay, classification, I'm going to diverge, but there's a whole lot of steps in there from scope to modifications to, rates and everything where they are still converged. That still leaves me in a world where, okay, I got to go to a system and then ask it to create an operating lease and then do different things from IFRS. And I have to have another version of that lease for IFRS. But the more of those decisions that had been different, I think at some point then I'm struggling to build the tool. So I think in this case where a lot of the aspects are the same, it does simplify the systems build and then also the training. I still have to be able to do GAAP right across the globe. So where I have markets that probably think more IFRS than they do US GAAP, but they've got to get US GAAP financial statements done for us and then local GAAP, which might be IFRS for them. That ability to get consistent accounting on a global basis is a struggle for multinational companies. So where you have converged statements, even if they're partially converged or mostly converged, it still gives me a better ability to do global US GAAP right, because I know the way they're thinking about in their market is more apt to be what I need them to be thinking. And I'm not trying to train them on nuances, difference between the two, which would be important for us. The transition topic, I guess we lived through it. So from my perspective, there's a ton of guidance there. So I think there's something that the two firms that talked about it are probably onto something about could it have been more principles or less volume. Maybe there's something there, but at least from somebody that went through it, I think back to the two major decisions we said probably weren't really negotiable items of, are you going to put it on the balance sheet in the first place? And then are you going to have two classification types? Once you made those two decisions, then okay, I'm in for the bulk of the investment. So I don't, and as a preparer perspective, I don't think the transition was really the issue at that point. So I thought like that section's fine. I mean, it gave us stuff. I think revisiting lease classification, I probably would have retired from accounting at that point because there's, tens of thousands of leases that we would have had to go back and reassess. That I think Krista makes a great point of, well, we'll live with this stuff for 20 years then. Yes, but at least I can live with it for 20 years. So I don't know practically how we would have done that. Certainly not within any timeline that you would have wanted us to adopt. Or we would have had to do some significant, expedients or progressions or things to get through. And then it would have been a nightmare for them to audit that, I think, if I had tried to say, well, let's just ignore all 5-year leases of X, and call them operating. So we would have probably made it through it, but I think that would have been quite problematic. And I think Scott's spot on the field testing. I think it's on us as preparers to be able to give you the right information and what do we need to do to get there. I think the FASB to try and pick up field testing in some fashion and maybe certain standards, like I said, TRGs I think are different for different standards. So maybe on some standards you could field test something like RevRec, because I think you could look at certain types of transaction types and think through the guidance and how would you apply it. But I think you do that through your outreach already. But if you're talking about something like a lease standard and saying, I want to go through and look at 100 leases, 5 leases, a segment of leases, and you're going to have to think through all the guidance that isn't out there, that is significant. I think lift potentially. And if you don't do it large enough, then I don't know that you're getting the value out of it. So I feel like that's more on us as preparers. If we're going to give you feedback on how much of an investment this is, I think it's on us to say, well, how much do we need to think about that? And how do we give you the right feedback? And do we need to do some kind of, test or thought process would be on us as opposed to the FASB trying to engage themselves on that, would be my view.
Thank you. Stephen?
Hey, thanks, Alicia. Rich, I think to answer your question on TRG, I think, my view is when you have multiple industries trying to write GAAP. And I think 606 was a perfect example of why, our voices had to be heard because, we needed to talk about how to get even the industries aligned on transition. And I think that there was an opportunity here to have people speak up and use the TRG to do that. I don't see that with leases. Leases are really legal documents that are pretty facts and circumstances are exactly in the contract, and they're the same no matter what industry you're in. So I thought I think there's more clarity there. But recognizing revenue from oil and gas versus life sciences versus financial services, whoa, there you go. You need a TRG. And so that so you don't have diversity in practice. And I think that it serves a great purpose for that, and having a voice at the table made a lot of sense.
Thanks, Stephen. Will?
Yeah, Rich, I was going to directly answer your question as well. I don't think sitting here for my company, my industry, we feel the absence of a TRG meant we didn't have a voice in this. I think, we have a trade group. We had dedicated resource on this. We have direct access to the firms. We had great support from the firms, and we had great interaction with FASB staff. And I'm looking at a list of 9 ASUs issued from 2017 to 2023, and many of those address specific concerns, questions, challenges that we had. And so, I don't sit here feeling like we didn't have a voice in this standard. And I think to me, it's a good example of how the process works. And I'm not sure for leases, I would have wanted it to be executed differently.
Any questions from board members? No. If not, what I'd like to do is move to the last couple of questions. And we did get into the PIR process itself a little bit because that TRG, I think, was one of the areas that we wanted to make sure to cover there. But I do want to open it up for any other observations or feedback on our PIR process itself. The activities were included as an appendix in your materials. And open to any feedback there, as well as just taking a step back and considering all of the discussion that we've had throughout today, as well as many of you have been involved in the aspects of the leases implementation, development of various aspects of it. But in its totality, we just wanted to pose the question about whether you think the benefits of the leases standard justify the costs. I think for some of you that may have come out in your comments earlier, but feel free, just given the conversation that we've had today and hearing your colleagues around the table, if you'd like to make any final remarks. And so with that, I'd like to open up the conversation on these last couple of questions. Derek?
Thanks, Alicia. So obviously, I wasn't doing the day-to-day or working at a company or an audit firm going through this. So the collective costs and benefits will be a little challenging. But one area that I do think academic research is particularly useful is assessing sort of market-wide costs and or benefits. So something that came up in the deliberations for the standard, there were some pretty infamous reports issued that suggested the standard would have these catastrophic effects on the economy, things like job loss, declines in GDP. Generally speaking, academic research has found no evidence of those declines. Certainly, there have been some winners and losers where some companies have had some economic consequences, others have benefited, but market-wide decreases in GDP, employment, lending, things like that, there's really no evidence that happened.
Thanks, Derek. Any other overall thoughts or observations about the process or overall? Oh, sorry, Kristen?
Maybe just one quick with respect to, I think it's really important to see a standard across a cycle. And so when the standard got issued, of course, interest rates were very low. Certain behaviors were doing certain things. We've seen different things now that, excuse me, interest rates have changed. And I think people understand what the new game is, where the guidance goes. And so I think it is probably very important to just, I know it takes, you should take time and kind of see that full cycle through to then really kind of get the full picture. I think we're getting there, but there's very much, today, the magnitude of really material transactions in the energy space and AI and some of these things are really coming to the forefront. And I don't think there's anything to do, but I think it is like observe how that all plays through the marketplace, and particularly the interest rate environment drives leasing to be a very favorable and interesting part of financing. And so they're looking for these ways. And so I just observe it is important to kind of see it across a time scale. I think that's really important to assess the productivity of the standard.
Thanks, Kristen. Any other comments or observations? So Chris, were you up from, sorry.
I mean, I think if we had hindsight and could do it all over again, we would have recommended that the board not touch lessor accounting. None of the investors or analysts that follow the REIT industry had any issues with how our members were reporting their rent. And I think while where you ended up was fairly close to where we started, there was a lot of time and effort spent along the way, both at the board, staff, and preparer level, that might have been saved.
Thanks, Chris. Sean, were you up from before?
No, I'm new again. I guess just from a preparer perspective, for us, the benefits wouldn't outweigh the costs because it's significant ongoing systems cost too. Because once you've put these systems in place, then we've now in a lot of cases you have to customize or get it to work because you're trying to use like real estate solutions that work for the business, and then you kind of get it to do the accounting. So you built that. So it's hard now. Anytime there's an upgrade to that system, that I've got to make sure the accounting all still works. So it's the ongoing systems cost is still high for us. And then headcount, we certainly use a lot more headcount than we did pre 842, and that we've gone to, this is normal operations for us now. So we're at probably our level. Maybe if we can ever get true optical readers to be able to bring lease contracts in and fill a lease tool, maybe that'd be great. But we haven't seen that work. So that could lower the investment, but that would have been available in 842. So if the PIR 842 versus 840 costs, it's certainly a higher cost standard for us. I think some of the bigger benefits you were achieving though of better financial picture, it's on the balance sheet. I mean, from a company preparer perspective, that's more esoteric to us. So it's harder for me to put that into benefits for me, as a company, so for us, it's certainly a cost. It's probably a little less heartening for us than to hear the analyst side say, well, a segment of them just ignore it. A segment of them use it as a double check. And then there's a segment that does use it. Well, if I'm into one of three segments that valued what's on the balance sheet, that's less exciting for the preparer who's trying to, put statements out there for the users of our financial statements. So for us, it is a net, net overall cost greater than benefits. But I realize some of the benefits of the standard, really weren't something we would have measured.
Thanks, Sean. David?
Yeah, we do use full stop across the globe, the liability that's presented on the financial statements, and everything else to do with lease accounting has to do with IFRS US GAAP differences and putting them into the right compartments. So all of the information from us is used. And I think the benefits and cost, all that type of thing for us, like the balance sheet number isn't the most important thing. It's the information and the disclosure that create the balance sheet number. And it doesn't save a ton of time to take your, if we had a commitments table that was consistent over time and a discount rate, and we understood the variable, short term, and all of these pieces, we could create our own balance sheet number that probably wouldn't be that far off. But all of the work of accumulating and making those leases consistent, because we used to have the rent expense and the discounting of the future obligations, and that obligations table was wildly different across companies and across the world. And now we have an management's estimate of this liability. We are able to communicate and use it consistently. We never cap it, we never move it, we never adjust it across the board. So it is used. But most of our concerns were about the inputs and things into that. If we had the tools to make a more like a reasonable estimate, that would have probably been okay for us, because then we could look at it both ways. But I don't see how that happens without all of this work on it. And it is unfortunate, but it is one of those things that a lot of the tangible benefits of having essentially global consistency into these balance sheet numbers are not really easy to quantify.
Thanks, David. Nate?
Yeah, just to kind of couple on Sean's comments, I definitely agree that, as has been pointed out throughout today, that the costs have been high. The benefits can be hard to measure, but at the same time, I don't want to be just another preparer complaining about the cost of implementing accounting guidance, because as a profession, it is important for us to get the right information to our users. But I think certainly there is debate here as to the cost benefit. So, I think overall successful, but certainly when we think through like the PIR and future reviews of future standards, just ways that we could further flesh out the cost benefit, I think would be helpful.
Thanks, Nate. Ron?
Yes, I just wanted to reiterate Dave's comments about, from an investor standpoint, that the benefits are very, very high to us from a user standpoint, from comparability. And we do make adjustments to the lease liability that's presented, but it is an important information for our model to, again, as a starting point. And to have the most important thing from an investor standpoint, we make a lot of adjustments to accounting data. That's kind of our business and our niche, and how we find insights. But to have a consistent input provided to us as a starting point is extremely valuable. Otherwise, we're kind of in the dark on where we're starting. We don't have a benchmark, and then we can make adjustments to that data. So just wanted to, again, iterate that it is a benefit to our models and our understanding of companies.
Thanks, Ron. Brad?
Yeah, I'd just like to reiterate what both Dave and Ron said. I mean, I don't use the lease information all that much, but it is very helpful for me in assessing not only just the balance sheet, but the liabilities there on go forward basis. And so, I always like to tell people in this room as preparers, when you think about it from an investor standpoint, the higher up the income statement you get, the more important it is. So this is a little bit lower down, so it's not as important for me. But the information that's derived, like the cash flow information and the notes, is very valuable, and I do use it. And so I understand there's all the cost to getting the systems brought forth and getting everything up to speed. But just know that there is a benefit and that we do use it.
Thanks, Brad. Tom?
Thanks. So on that cost benefit question, I think there's more work to be done, especially for smaller private companies, especially when you read feedback about mixed user feedback in the private company space, consistent with that earlier memo that I cited. And I talked about some of the things earlier that to focus on, at least from my perspective. A couple of things that answer other questions about process and effective date. I would be remiss again if I didn't bring up not-for-profit conduit debt obligors being roped into this with public business entities. And I get that some universities and hospitals, that may make sense. But, for example, small parochial high schools in Cincinnati where Nellie went to school, client of the firm, I don't think their users are using those statements the same way that some of those large universities and hospitals are. And I know this issue's been brought up before, and I would encourage the board to, further peel that back and setting the right effective dates, and also recognition and measurement, because that does affect some of those decisions that were made there as well. About process as well, I would also want to make a subtle observation that dawned on me a year ago when the ISB was here and the FASB was here, and there was a pretty healthy debate in that meeting, and obviously open, about their decision on IFRS for SMEs and the decision that was made for US GAAP, and some perspectives were exchanged. And I thought that was very interesting, and it was transparent, obviously, and provided some feedback on thought process. And it got me thinking about, there was a subtle change in the way board meetings are conducted post-COVID, where we don't have as much of that debate anymore. It's a lot of the staff introduce an issue and there's questions and then there's a vote, versus in the past it was more debate and then raise your hand to see if you got 4 votes or not. And the benefit of that debate was just to get some ideas as to the rationale behind the decisions, which is helpful to bring to clients, especially for those that aren't as well connected with the folks in this room. Thanks.
Thanks, Tom. Any other observations, questions, suggestions? Just looking around the room slowly in case you need to get to raise a hand. Seeing none, I just want to end this by, first of all, thanking all of you. We really appreciate your willingness to come on a Friday and to spend this much time talking about leases specifically, but also your participation in our process throughout. It really has been impactful, and wanted to thank you for that. I also want to thank the staff led by Chris Roberge, the staff that you see at the table, as well as staff members that have come and gone since then. So I know some of you expressed your appreciation to Chris, but just wanted to extend that as well. As I mentioned at the beginning of the meeting, we are working toward issuing a final report, but that does not mean that we're closed for business ever, right? So if you've got questions that come up on this standard, on other standards, through the agenda consultation, TI process, we look forward to those continued discussions, and just really hope everyone has a great weekend. And thank you so much.